29th is Monday, is that correct?
Yeah.
Yeah, okay, so let's tentatively plan on a brief presentation on that day. I may hurry it along a little bit, so I'm just going to give some guidance on what I was looking for, right? Amount of time. So let's stick with that. If I didn't, let's talk about it right now.
Are you talking about the group?
Oh, April 12th, I said.
Yeah.
Oh, sorry, good. No, I'm sorry, take that back. And so we got a ways out. That's good. I changed that date, so I had on my calendar an earlier date for that. So yeah, good. So we'll look forward to seeing that later. What I'd love you to have for your classmates is a quick handout that summarizes the bullet form points you're going to talk about. We're definitely not going to have more than 10 minutes per group, and you decide however you want to present your group's perspective. Okay, this will not be a debate. It will be much more of a like we did last time, with a different presentation style. Your job is to walk up to the front of the classroom and give your perspective in whatever way you think is most interesting, and then sit down and we'll kind of run through all the different groups. So it's intended to be an eye-opening, positive. Here's some different ways to look at the world discussion that we're going to have. Okay, and there's plenty of room for all the perspectives to kind of coexist in this case. Well, maybe not, but we'll talk about. I mean, for the most part, yes. With a couple of distinctions that we'll talk about a little bit. Hopefully this works. Having trouble getting the technology to work. This is good. Okay. My little theme cartoon for today. A couple other small things that we've been talking about, and I'd like to talk about a little more. And then I'll just hand these around. You know, it's nice if you can connect the dots on different content points. We've been talking about risk and return. We spent a lot of time talking about kind of this picture. Let's take us back to our last conversation. But we spent a lot of time in this space, right? With respect to return on that axis and standard deviation on this axis. You all recall this picture? Tyler, do me a favor and flip the lights on, because I think I'll use just the board for a few minutes, and then we'll flip back and forth. And I might have one more for you, so sit comfortably up front there if you don't mind. Sure. So we spent some time talking about this space, and we developed the choice set that looks kind of sort of like that. You all recall this conversation last time? We developed that for you. We added in riskless lending and borrowing. And we found that there is a tangency solution. And the point I was trying to stress to you is that, you know, this conceptual result, early 50s. But following that, and it took about 20 years, and it took more than 20 years to kind of get this straight, we've then also described what the required rate is a little differently so we can be a little clearer on the discussions. We might really want to know what's the required rate of return on any given asset J, we write it that way, in relation to its beta, which is a measure of, let's write explicitly down below here, which is in relation to its systematic risk. Okay? Are you with me? And in this picture, the risk-free rate is still the vertical intercept, and it does continue back, but let's not worry about that for now. And this is called the security market line. This is called the capital market line. Let me say a little bit more and kind of jump back and forth between theory and apply in application. All right? So last class we talked, ignoring everything to the left here for a minute. We don't have any of your notes yet. We're just about there. But in this picture here, this is what we devised last class, right? And the only thing I've added is I've called this the CML, or the capital market line. Everything else is right out of your notes. You don't actually call this the capital market line unless you make kind of one big set of assumptions. And that big set of assumptions is that all economic agents see this picture. So if all economic agents see this picture and think this is the risk-free rate, say these are the expected returns, or these are the risks of all the assets, and they draw this picture, all economic agents are going to end up with this point. Agreed? I'm being a little too global and too broad in my assumptions, but I still want to stay there because pedagogically it's easier. So if everyone sees this picture, we end up at this point, and we all should form a portfolio that's comprised of this portfolio here and this portfolio here, right? We had some conversation last time about why being on this dotted line was better than everywhere else in the picture. Agreed? Don't remember you're happier in the Northwest and that conversation? So if someone says, I'd like to have a portfolio here, you say, no, you should get to here. And we talked about how. And if someone says they want to be here, you should say, no, you can move up to here, and that's better. At this point here, you could either move up or you can move back. And in both cases, for a risk-averse investor, you can make a strong argument about why a point on this line is better than any point on this curve, or its interior. Right? Okay, good. So all of that conversation, though, gets you to the point where everyone doesn't see the same picture. You still have the same argument, right? I mean, there can be a back room in any investment house, whether it's Wells Fargo, Fidelity, Vanguard, it doesn't matter who. They can draw that picture for all of the assets that are out there. And it doesn't matter that they agree with the other investment houses on the street. They're going to form the best portfolio for their clients. Do you follow? So I can say for IBM, I think its expected return is here, and its standard deviation is here, and it co-varies with a bunch of other assets in particular ways, and it plots right there. And Microsoft plots right there. And all these other assets plot in particular places. And we can use the mathematics we showed you in class more efficiently than we showed you in class. We just did it in a way that was easiest to teach. But I can draw this picture effectively for all of the assets that are out there, and I can form this portfolio for my clients. So we're going to spend some time talking about the application side. But just before we do that, and I'll come back to that shortly, that's why I brought some other things to pass around and show you on the viewer today. But before we do that, because this stuff is very, very applied, let's kind of push to the next level on the conceptual side and show you where we're going, and then we'll go back to practice and back and forth to practice and theory for the next half hour or so. So, and we're pretty much done our notes, but not quite. So, but I don't want to lose the application piece of this. If I say, so let me back off a little bit from what I said. So I said that all investors are the same and they all see the same picture, and then we get that result for all investors. And then, if we were to do that, then all investors would choose either to be in this portfolio or this fund, let's call it, which is a riskless investment. Do you all see that? So we have what is called two-fund separation. Do you follow two-fund separation, the logic there? Here's how it works. You first define the optimal risky portfolio, that's the tangency point, after you draw this picture. That's step one. Step two is, and that defines, I'm going to start calling this M now because we've got all investors seeing the same picture. So we first define the optimal risky portfolio, and I'll call it M. There's an aha in there that will stress as we move forward. And then you say how much money should you put in M and RF. And that's two-fund separation. So you deal with the problem sequentially. Get it? Got it good? Very important result. It means that you don't have to worry about holding individual assets. You don't have to worry about putting money in IBM, money in Microsoft, money in GM. You just want to be well diversified by putting some money in M and the rest of your money in RF. And when I say it that way, we're allowing lending or borrowing. We showed you lending is between M and RF, and borrowing is going in the other direction, right? So then the aha that comes out of that is, but that means if there's only two funds held, and we know IBM exists, there's no way IBM is there, right? Maybe IBM's here. You know that it's got a lot of undiversified risk, right? You know that if you put your money in IBM, you're not in a well-diversified portfolio. Remember our picture where things move down as you add assets to your portfolio? So it can't be it can't be that optimal portfolio. And if you don't like me saying that about IBM, choose another company. I don't care. That's going to be true for every individual company, right? But if all investors hold M, then the only way individual assets can be held is so that they're a part of M. You follow? So that's the problem that took 20 years to solve. And that's what Sharplinger and Mawson did. And they came back 20-some years later and said, okay, in this picture here on the right, all investors decide to be in this portfolio. So in this picture, and how many portfolios are on the line here, the dotted line? Just look at it. Only one, right? There's only one efficient risky portfolio. Everything else is inferior and below the line. So then what Sharplinger and Mawson did is said, what does that mean about how individual assets get priced so that they're a part of M? So what's the price of IBM so that it offers a return that allows investors to hold it as a part of M? And it took us a long time to figure this out as well, but it's not just the case, and I'm saying it this way, right? I'm saying, what's the price of individual assets so that they're held in M? So that I can say, what's the required rate of return on IBM given its beta? And now all risky assets in equilibrium are going to plot on this line. So this is an equilibrium relationship about all assets that are out there, such that they're held in M. I just want you to have the rough intuition here. This takes some time to work through step by step. If you have an interest in it, you're going to have some discussion in your text, and you want to talk about it, come talk to me, and I'll give you the 2 or 3 chapters to read on the good investments text. Okay, but it takes some lifting and some work, and it's an equilibrium relationship. You follow? Well, Roll, about 77, which is a few years later, said, wait a minute, you're wrong. It's not just this gives this. It's also, if this is true, then this. In other words, it's if and only if. So if we talk about linear pricing through the security market line, or we talk about one optimal risky portfolio in this space, there are if and only if relationships going back and forth. So this implies this, and this implies this. Very strong. You don't have to be quite as restrictive as I was saying all investors see this picture. What you really need from an economics framework, and most of you don't do this stuff, I know that, but I don't want you to think that we're throwing everything out when we make the assumptions to draw the picture. What you really need is the ability to create what's called a representative agent. So think of throwing a whole bunch of diverse people into a big boiling pot, stirring them up, and being able to reach in and pull out a representative agent, or a typical investor. If you can do that, if you have the conditions to do that, then you can build this theory. You follow? So it's not as strong as saying all investors have to be the same. That's way too strong. But it's nice for teaching. Now clearly this model is going to fail. All models fail at some level. You all understand that, right? But it's also the beginning model for all other models. So let's see how far we can take it and what we can learn from it, okay? After this result was shown at the outset, and if you don't make the assumption that all investors see this, this is not the capital market line and this is not the market portfolio. This is just the optimal risky portfolio for that investor, right? So for instance, if Mike draws this picture, looking at all the assets that are out there, when I say Mike, I mean the investment house that Mike runs, because there's a back office doing this, right? If he finds his optimal portfolio is some portfolio, let's call it M still, but I don't mean the market anymore, and some kid has a different back house and a different company that has different inputs, he's going to get a different optimal risky portfolio. But both of them are going to sell that to the marketplace, right? But you should understand that we really want to think about what portfolios we want to add to our kit. And there is another, this is kind of the point of departure for asking the question now, how do I beat the market? This is if everything's in equilibrium. But what if you're a great analyst and you can find stocks that are underpriced or stocks that are overpriced? You need to be able to do it in this context to add value for your investors. Let me give you some for instances. I have a bunch of analysts and we see what people look at the market level. But I have an analyst that says, the market's wrong. IBM is worth more than this. And if IBM is worth more than its current market price, by investing in IBM, you're going to do better than everyone else. But as you start putting your investment in IBM, what's going to happen is your portfolio is going to become less and less diversified as you start tilting more and more towards IBM. You follow? And IBM is just a particular company name. Choose any particular strategy you like here and insert the name here. You follow? So at the marginal level, we're going to be able to ask, as you move on to other finance courses and so on, if all securities are supposed to be priced on this line, let's say this is IBM, and this is the required rate of return on IBM. And let's say we're a great analyst and we say the expected rate of return on IBM is up here. Do you follow my story so far? So I've got the red circle here is the expected rate of return on IBM. If I look at IBM's cash flows, I'm a great analyst, I say IBM's going to earn 4x beta, we can look this up on Yahoo, okay? Go ahead and use that as a little exercise. Find IBM's beta on Yahoo, and let's say it's 1.1. Someone go ahead and do it correctly, so we'll fix it, okay? And we have a required rate of return here. Let's say that's 10%, and let's say we find an expected rate of return of 12%. You follow so far? Yes. This is a good stock to buy, right? This is going to happen when the price is too low, because if the price is too low and the price recovers and goes up, the return is going to be big looking forward. Follow? So this difference is what you're trying to capture. But as you start thinking about investments further, it's not just sufficient to say 12% is good, and you compare 12% to the average market return. You have to compare 12% to what the required rate of return is on the market based on its risk. 12% might not be good if its beta's way out here, right? Because then it should earn more than 12%. You follow? So you need to make the risk adjustments through this picture. What financial analysts talk about, and if you read in the press, they will talk about this distance, and they're going to call that the alpha of IBM. And we can get the alpha back from a simple regression, which is nice. But alpha tells you how much extra return do you get expected above what you ought to get. And analysts are, in fact, there's a magazine called Seeking Alpha. And there are hedge funds that are basically have alpha strategies, they call them, which are trying to capture these terms. In other words, even though there's a lot of math going into this, and you think, well, this can't have any application to reality, this is exactly what is used in the investment industry. Okay? And it's all kind of right in this picture here. We have to add some more equations to it, but let's leave this up here and keep talking about it. You're all very quiet, but are you roughly following? Good. We spent some time talking about funds before. It's worth spending a little more time. You know, when you turn on, so you know that's a good thing to invest in, right? That's a good beginning point. And as I mentioned to you before, kind of good practical, we're not going to get into the math as to why this is true, but it is true mathematically. It does make sense to kind of follow the logic sin, but only a little, if you want to try to beat the market. Because as you start moving away from the market, if you start tilting more towards IBM, that whole story makes sense if you put a little more money in IBM. But when you start putting more and more money in IBM, what happens to your portfolio? Well, it starts moving away from M, right? So if you start tilting towards individual companies or individual industries, you start becoming less and less diversified. And as you become less and less diversified, you take on more risk, more unsystematic risk. So we have to penalize you, if you like, in terms of the risk you take on, as you're getting that extra bang for your buck by choosing good stocks. And you want to weigh that change, right? Really, you can do it in that picture over there by saying, let's say we find an individual company, you know, that plots out here, and there's a way to combine this with this. I can do that, right? Remember that from before? That allows me to form a new optimal portfolio out here that's better than this one, because I know more than the market, and I'm able to find this one. Do you follow? Kind of repeatedly applying the same logic. That leads you to other performance measures like appraisal ratio, which take the alpha and then correct it by the unsystematic risk that you create. Way beyond what we're going to talk about in class, but this is still the beginning point for kind of most modern performance evaluation and how we think about it. Okay, let's leave it there though. So how do I form one of these portfolios, and how do I think about things, and what do you see when you turn on the paper in the morning, or when you open the paper or turn on the TV? So when you turn on the TV in the morning, what do you see in terms of how the market's doing? We talked about this once way back when. Someone said something, I didn't hear it. Mr. June? You see the index? Which index? Dow Jones Industrial Average, good. Let's talk about that one. What else do you see? I'm going to show you a few of these things. A little louder, I just didn't hear you. The S&P 500 we talked about in class. Usually don't see that much on TVs, but you do on computers, right? And it's, as we said in class, it is the typical bogey for a large cap portfolio. So if you're looking at a big mutual fund manager, that's what they look at typically, is the S&P 500. What else? Just throw some other names at me. We passed around some. The NASDAQ is pretty common to see. Good. Let's talk about these a little bit. What does the NASDAQ measure? Kind of more technology-focused stocks, right? The NASDAQ market. And the Dow Jones Industrial Average follows what? One more time? The blue chip companies, good. So it takes 30 blue chip companies, and blue chips in poker are the expensive chips. So these are the big, safe companies, like we talked about in our example last time. The Dow Jones Industrial Average, if you wanted to ask how the market's doing, is probably one of the worst indices you could follow. But it has the longest history, and it's by far the most actively followed. So let's talk a little bit about it. And it's a great one to understand in terms of understanding how the market behaves. Really, it goes back to, well, a long time ago. And it asks the question, what if you were to invest in an equal number of shares? Remember when I talked about how expensive it is to buy individual shares? But it would still be nice to report for all of our readers of the newspaper how the market's doing every morning. So let's create the following hypothetical portfolio. I'm going to buy 100 shares of each of these 30 companies that are in the Dow Jones Industrial Average. And I'm going to see what its returns are between this interval and that interval. Good? So I'm going to buy 100 shares of each of these 30 companies. I'm going to measure what the price is at the beginning. I'm going to then look at what the cash flows are over the period of time. I'm going to look at the prices at the end, and I can see what I earned. If I can buy those 100 shares of each of those 30 companies for $12,000 and sell them for $14,000 and get the cash flows from them, I take 14 plus the cash flows divided by 12, and that's 1 plus my rate of return, right? Everyone's comfortable with that? Very simple problem, right? So that's how the Dow Jones Industrial Average works. Of course, weird things happen. So it's a little more complicated than that because we need to change this divisor thing as we move through time. I'll leave that for you to worry about. I can talk about it if you want, but your odds will glaze over in a hurry, and you don't learn much intuitively. The problem is, what happens if there's a stock split? What's a stock split? So let's say a company, is trading at, like a Berkshire Hathaway kind of a company. Let's say it's trading at $10,000 per share, and you want to make it trade at $1,000 per share. All you need to do is push out 9 shares for every share that's out there, and then every investor will have 10 shares where they used to have 1 share, right? And if I give you a piece of pie and I break it into 10 pieces, what do you expect the price of the piece to be relative to the price of the pie? Well, 1/10, right? Everyone follows that? But now if I said my portfolio strategy was to invest in an equal number of shares in each of these 30, I now have to sell off a bunch of those shares of Berkshire Hathaway, right? Because I'll now have 10 times as many shares of Berkshire Hathaway in my portfolio versus all the other companies. Are you with me? So I'm going to have to sell off a bunch of them and buy shares of the other ones, so I'm back to equally balanced in terms of the same number of shares of each of the stocks in my portfolio. Did you get it? So there are little things like that that happen over time that force us to tweak the index. And then we need to make sure that it doesn't take jumps that aren't related to returns, but are just related to this issue. So we've got this other little algebraic trick we do called the divisor. And the divisor is going to change over time, just so that the path of the series follows the same level. I could go through a bunch of examples, show you how we do it, but trust me that the original intuition is all we need. Okay? So the original intuition, again, is buy an equal number of shares of all of the companies in this index. Good? That's called a price-weighted index. You follow that intuitively? Great. How about, what are some other ways of forming portfolios? So price-weighted is one, where you buy an equal number of shares of each of the companies in your index. Do you know any other ways? You already do, actually. Is that the same as the strategy I gave you when we drew that picture that did this? How did we do that one? Anyone recall? If you invested, you won't find it in your notes. We talked about it a bunch, though. If you invested 100, go ahead, Adam.
I don't remember.
Brainstorming, no wrong answers.
Like investing the same amount of money rather than...
Perfect. That's exactly what it was, right? If you had 100 grand and you had 2 stocks to invest in, you invested how much in each? 50 grand in each. That's not the same as price weighting, is it? In the price weighting case, if one company is worth 100 bucks and the other company is worth 50 bucks, you're going to have twice the investment in the company that's worth 100 versus the company worth 50, right, in your overall portfolio. That's a different strategy. It's going to behave differently depending if the higher price stock does better or worse relative to the lower price stock. Agreed? That's called an equal weighted strategy. Equal weighted is really nice for our algebra, and it's actually used in practice too. But it is a tedious strategy because if you have an equal weighted portfolio and you want to maintain it over time, what do you have to do? Someone give me an example with 2 stocks, or think through it a little bit. I want you thinking about portfolios now and what we look at in the marketplace and make sure we can connect the dots here. Go ahead.
Well, the market rate's going to go up and down on each of those stocks, so it's going to fluctuate every day. So you're going to have to...
Perfect. Let's do a 1-year example. So over 1 year, I start with 50 grand in each of 2 stocks. One stock earns 20%, so my 50 grand goes up from 50 grand to 50 grand times 1.2. And let's say the other one stays neutral and doesn't do anything over that year. So its 50 grand is going to become 50 grand. At the end of the year, I have 50 grand in one stock and 50 grand times 1.2 in the other. I'm going to need to sell off the one that did well and buy more of the one that didn't earn anything, so I'm back to equally weighted for the next period. You all follow? That's called rebalancing. And we often do that on a personal finance from a personal finance kind of perspective when we choose, well, I want this much internationally, this much in my bond portfolio, this much in my equity portfolio, and so we call that rebalancing. You follow the term? And that's kind of a good personal finance strategy, most people think, in most cases, kind of for your next finance class. Talk about that. But in terms of an equal weighted portfolio, that implies a rebalancing every period, doesn't it? Because if you're going to be equal weighted for the next period, you've got to sell off the winners and buy more of the losers. every period, so you're again equally balanced each period, right? So you think it's a nice simple strategy, but it's actually a very active strategy. For a very passive, kind of idea, it actually requires a fair bit of trading, doesn't it? There's another strategy that's really built into this picture here that's different than price weighted and different than equal weighted, and that's called value weighted. And what you do is you buy the amount of shares. Let's stick with our two company example. But you're going to buy the number of shares that correspond to the value in the marketplace. So if I take a look at the market value of IBM, of company 1, and the market value of company 2, we'll just stick with our two company example. If one of those market value is twice as big as the other, I have to buy twice as many of those shares than the other. You follow? So those are three different strategies. That last strategy is the one consistent with our theory, because we want to be market value weighted in the market portfolio here. And that's what the theory says we should do. The nice thing about a market value weighted portfolio is when that company goes up in price, what happens to its market value? Its market value goes up just in proportion to what you want it to, so you're again market value weighted looking forward. So we would call a market value weighted portfolio a buy and hold portfolio. So if you buy a market value weighted portfolio and you hold it, you'll stay market value weighted. It's passive. You don't have to do anything with it, which is nice. And then if you start thinking a stock is going to outperform, you can leave the theory a little bit and try to tilt towards one of those ones you think is going to do well. So let me show you some examples of some of this stuff so we can get our theory connected with our practice, which is all we've been talking about here. Let's go back to the Dow, because the Dow is the easiest one to start with. The nice thing about the Dow is there's only 30 pieces, right? So I'm using these examples to give you the difference between price-weighted, equal-weighted, and value-weighted, and we're talking about two companies. But no one forms a portfolio of two companies. We know that we typically want 500 companies-ish in our portfolio, right? Or more. Let's talk about the Dow, though, because it gives us a nice kind of first point where we can think about, let's invest in an equal number of shares of 30 different companies, because then I can show you a table where things look reasonable. So the Dow, you understand, is created by the media to show us what's going on in terms of the market as it's measured by these 30 companies every morning. The Dow, though, is not investable, is it? I mean, the Dow is a creation of the media for us to see what's going on in the marketplace. If you want to invest in the Dow, you have some choices. You could decide to create a Dow-type portfolio by investing in an equal number of shares of each of these companies, and then monitoring it over time, like I talked about when one company does a stock split or a stock dividend and other things happen, right? You could do that on your own. Or alternatively, you could say, hey, does someone have one of these things out there for me? And so the biggest product that people tend to look at is called diamonds. So this is an old one. My wife's much more environmentally friendly than I am, and so all my stuff is pretty dated. I apologize, because I get everything electronically now. So but let me give you some hard copy things to look at. So this is 2002, so it's real old, but the point is still here, and I'll circulate this for you to look at. The Dow Industrials, or diamonds. So you've heard of diamonds before? How many people heard of diamonds? How many of you heard of cubes? QQQ. How many of you heard of spiders? Good. Okay, what are spiders? Just heard them. That's good. That's all I want. So, and you'll see ads for them. You'll see little spiders and so on that they'll show. But these are actually the products that you can buy in the marketplace that mimic those underlying indices that you could create in terms of a thought process. So the Dow Jones Industrial Average is this creation of the media. But if you want to invest in the Dow Jones Industrial Average, you would actually have to follow a strategy, a relatively straightforward strategy. But it would be nice if someone did that for you, and then you could just buy into that strategy without following the strategy, right? Diamonds are the example of that very simple strategy we just talked about. So if you look at diamonds, this is an investment in the Dow Jones Industrial Average effectively. I'll pass this around so you can see it. I just wanted to show you this page as for instance. And I'm going to leave the lights where they are, because I'll pass this around and you can see it. But what do you notice? So you see all these companies here, and again, we're 2002, and the index changes, so this will be a little wrong, but you get the gist of it, right? You have all these companies here in the first column. Here you have the number of shares, and here you have the value. Are these numbers the same? Absolutely not. But notice every one of these numbers is the same, right? That's the point I'm trying to stress. It's a price-weighted index, right? Which means we buy an equal number of shares of all of the companies, and that's going to lead to a different value per company because their share prices are different per company. Just like that first example we talked about with stock 1 and stock 2. It's exactly that example, except for now we have 30 stocks. You all follow? This is a nice place to begin, because you can see it all on one page. Not a very well diversified portfolio, but again, kind of interesting. So let me pass that around. You can take a look at it. I don't know how many of these I want to go through. Let's go through spiders as well. I'll just pass some of these things around so you can get a sense. The nice thing now about many of these indices, you know, going back to kind of how these results came about, you're thinking back to, you know, results from the 50s from Markowitz here. And then you've got Jack Bogle coming out, and kind of prior to this stuff even, you've got Jack Bogle coming out and saying, wow, I want to create a portfolio like this for individual investors so that they can, with one step, invest in a well-diversified portfolio. And so he brings out index funds. At the same time, you have others saying, let me create a portfolio that's not just M, but it's my M. So I have a better M than everyone else. That's Mike talking about his M being better than Songkit's M. Remember that conversation before? So we can have actively managed portfolios. I mean, if you're on the street, you're going to say, I buy what you're saying about diversification, but my analysts are better than your analysts, right? And so I'm going to actively manage my portfolio and do better than you. And so I'm going to sell an actively managed fund, and Songkit might say, no, I'm just going to be the market and sell a passive fund that tries to represent the market. We can talk about some performance metrics, but without overstating things too much, because there's some debate on this, there's not much evidence that active managers that try to beat the market beat the market. There's actually a lot of paper, you know, there's an occasional paper that will say, in this context, in this situation, these managers outperform the market. But there's far more evidence, far more evidence that says that active managers charge more than they generate in value. And that investing in index funds, so just start with that as your beginning point. That's all I'm asking. I mean, you always offend a couple of people when you say that. But let me start with that point. Make sure you're pretty convinced of the evidence before you deviate from the index fund. And the index fund is trying to, at very low cost, create a well-diversified portfolio for you. Do your record keeping, put you in a diversified position, and not charge you too much for it. And that's what Bogle initiated. He said, let me create that low-cost fund for you to start with. And so now we have a bunch of competitors. But mutual funds, as we think about them, let's talk a little bit about terminology, because this is where it'll help you a bunch when you leave class in your personal lives. So you walk down the street and you have to go to your HR department, going back to our very first lecture. Remember we talked about getting your first job, walking into the human resources department, and they say, how much do you want to put in these various different investments? And you have to know the answer to that question for you, along with your insurance needs, along with a whole bunch of other decisions you got to make when you start your job. So it's worthwhile thinking about this stuff. What are some of the terms you need to be aware of? And similarly, you're going to be making the same decisions at the end of each year when you contribute to your Roth and your traditional IRAs, which you know because you did an assignment on that. So tell me some of the terms you need to be aware of when we talk about the mutual fund industry. I want to talk about mutual funds a little bit here. Sidebar, not examinable, but very important for you. And I want to talk a little bit about ETFs, because I'm showing you a bunch of stuff on ETFs now. So tell me what you know about closed-end about mutual funds. What's the difference between open-end and closed-end, for instance? Anyone heard the difference? Almost all mutual funds are open-end, and what that means in our class terminology is that if you want to buy shares of the mutual fund, they're always open for new business. They're always willing to take new money. Remember the picture we had where we had all the individual investors over here, we collected all the money, and then we invested in the various shares over here? An open-end fund is always willing to take new clients and always willing to let clients cash out. So the primary market is always open. You follow? A closed-end fund raises a bunch of money, just like our picture, and then closes the primary market and says, no, you can no longer put new money into this fund or take money out. So the primary market is open once, they generate the cash, and then they close it and they stay closed. So if you buy into a closed-end fund, Evan, and you no longer want this fund, what do you do?
Put it on the market.
You sell it. You sell it just like an individual stock in the marketplace. But you don't deal with the company, the mutual fund company, you deal with other investors in the marketplace who buy and sell that fund. You follow the distinction? If you were to grab a fund at random, it's almost certainly going to be an open-end fund. But you'll see closed-end funds listed, you know, in the Wall Street Journal or wherever you want to look frequently.
What's the purpose of having a closed-end fund?
It's simpler from the company's perspective, right? It's simpler. And the other reason I want to stress it is there's a puzzle that we don't have a good answer for, and that is closed-end funds tend to sell at a discount from net asset value. I don't want to go, let me just say that quickly because I'm interested in kind of laying out a bunch of practical terms and then leaving it alone, but I don't want to go 3 steps beyond class here. But net asset value just measures, if I were to take, we talked about 2 companies, right? We talked about company 1 at $100 per share, right, was its stock price, and we bought 200 shares of it. And we had company 2 that had a price of $50 per share, and we bought 300 shares of it. Do you follow? That might be a strategy. If I looked at that strategy, at the end of the day, I could say, what is my investment worth in sum? Agreed? And I could divide that by the number of mutual fund shares that I generated, and that would give me the net asset value, right, of my mutual fund. You follow the term? Just intuitively is all I need. But that net asset value isn't necessarily the same as the price in the marketplace, right? That's set differently, isn't it? And the reason I want to stress that, if the market's working perfectly and there's nothing else going on, you'd expect those things to be close to one another, wouldn't you? Market price and the net asset value. With closed-end funds, we tend to find what's called the closed-end fund discount, where the market price is below the net asset value. They also tend to charge more, and it's not an easily arbitrageable difference. You know, what you might think is, well, that's great. What I'm going to do is buy it in the marketplace and mimic the strategy to capture that differential, right? You might be able to take a strategy that way to capture that discount, because it can be as big as 15 to 20% or bigger. Okay, and it changes over time, of course, because the price is changing and the net asset value is changing. But that puzzle is called the closed-end fund puzzle. So I want you to know the difference between the two. How about load fees? What are they? Who's heard of front-end load and back-end load? Terms you really should be aware of. So you avoid them. Yes, they're sales fees. So typically when you buy a fund, not typically, when you buy a fund up front, if they charge you a sales fee at the front end, so you have $100 to invest, multiply by any factor you want here, you have $100 to invest, and they tell you that the front end load is 5%, you're really not investing 100, you're investing 95. That's all that's going to flow through to our conversation in class, because there's a sales fee of 5% that goes away before you start. That's a front end load. A back end load is the same thing, but it gets charged when you withdraw your money from the fund. So typically how a back end load, every fund is different on this front, right? And they can sell their underlying investment strategy 7 different ways too. So you need to read the details. But typically a back end load changes as you move through time. So they might say something like the back end load is 8%, but if you hold the fund for more than 5 years, we waive the back end load. So they don't charge you any back end load fee as long as you hold it for at least 5 years. Do you follow? Or it might be sliding scale where it slowly goes away. Get it? Got it good? But whatever you pay in a sales fee up front, you're not making money on. Right? And technically with most index funds, actually let me not go quite there yet. So those are kind of the typical, some terms you should be aware of when you're looking at mutual funds in general. If you call Vanguard, if you call Fidelity, if you deal with funds that are offered by those companies in your pension plan, you have all those issues to think about. Typically open-end funds, and you'll have different fees that you have to worry about. There's also going to be an expense fee paid per year in terms of managing the fund, right? And that's going to vary with how much they're trying to beat the market by, or are they just trying to be the market, like an index fund. So the index funds will tend to have the lowest fees. Then there's this whole new category of things that we've got now in the modern world that allows us to buy and sell mutual funds effectively, instantaneously in the market, just like individual stocks. And those are called exchange-traded funds, or ETFs. And we're already looking at our first one. Diamonds are an ETF. So when you look at a diamond, if you want to buy and sell shares, if you want to buy and sell units of a mutual fund, you call your mutual fund company, or through some other broker, you call and say you want more units, or you want fewer units, and you want to change units, and so on. And what will happen is typically at the end of that day, they'll put the transaction through for you, which is just fine. You probably shouldn't be day trading your mutual funds anyway. But with exchange-traded funds, your strategies are implementable in real time. So if you want to buy shares of diamonds, you buy and sell diamonds just like you buy and sell shares of IBM. They're bought and sold just like an individual company, like the closed-end funds we talked about. In fact, exactly the same. You get it? That's how exchange-traded funds work. So let's talk a little bit more. Let me pass a few more around. This is really old, but I don't have, like I said, I have plenty of, yeah, whatever. Actually, I want to hold on to that one for a second. And when I talk about it, you can release it. Go ahead and release this one. And I'll hand them out next class again, if that's interesting to you all. Gosh, I gotta get through a bit more of this. So let's talk a little bit about spiders, because they're the most standard one used. So spiders are Standard & Poor's depository receipts. So if you wanted to invest in the S&P 500 and you thought that was a good index of a good representation of M, and you wanted to invest in the S&P 500, you could invest in Standard & Poor's depository receipts, and with one investment in spiders, you could represent all of that M. Understood? At very low cost and in real time. Not only do you have to just invest in spiders that way, so that does the same thing with spiders that we saw in the diamonds, except for now you're talking about 500 companies, so I can't show you, it's not even worth bothering. But you're going to see what the investment in each of those 500 companies at a point in time. Do you follow? But it's not just the 500 companies in the index. It also gives you, let me give you an example about what else it gives you and how you can use it. It also gives you the ability to invest in individual sectors. So it'll say, you can think of the world as broken down, not into all of the market like we're looking at, but you might think about 10 different industry sectors where we group companies up into particular lines of business. And so now I have these 10 different lines of business, and instead of thinking about just the S&P 500, I'm going to have these sector funds that represent what's going on in different indices. Understood? Let me give you an example about how that's used in practice. Because you might think, well, why would anyone care about that? And there's lots of applications. Let's say again that that Eric runs a fund, and Eric's job is to beat the market in different sectors. But Eric's clients are trying to invest in M, and he runs an active fund, and he's seeking alpha, like I talked about earlier. So in every sector, he's got, and this is very typical, by the way, he's got analysts in every sector of the world, and those analysts are trying to choose stocks to invest in the auto sector, in the telecoms, in these other sectors. Do you follow the story? But let's say at any given time that Eric's analysts in the auto sector don't find anything they like. You know, they don't find a given company that they think is going to outperform. Or they're doing their due diligence and they just haven't come up with a decision yet, and they're waiting. And that's often the case, right? You know, you've got a great investment, it's done well for you, or it's done poorly and you got to get out of it, and now you're deciding what you do next. But what do your investors care about? Your investors still want a well-diversified portfolio, right? So what you'll often do, for instance, in that example, this is just one strategy. You will always be sector weighted by choosing the sector spider. So you'll have an investment in the sector spider for autos. And then when you choose your bet on Ford, or your bet on GM, or your bet on Toyota, then you'll sell off the sector spider and invest in that company. You follow? That way you'll always stay fully invested, and you'll be allowed to make your gambles on the companies that you like. But you'll still stay fully diversified. A very, very often used strategy, that one I just laid out. Do you all follow it? There's lots of other strategies you can use. You could also use, let me give you one more example that's similar with those sector bets. Let's say you think that, that Toyota's been beat up too much in terms of the recent news. So what you might decide to do is you want to buy Toyota. Good? Everyone gets it? That would give you that play. But let's say as well, you just want to make that play. In other words, you just want to buy that penalty that Toyota took. But what happens if, and so you put a big investment in Toyota. What happens if the whole auto sector goes down? Is Toyota going to go down with the auto sector? Almost certainly. But maybe it doesn't go down as much. So great, you're right, you still lose $1 million. That's kind of disappointing. So if you really want to make that bet, what you might want to do is buy Toyota and sell the spider. And that's going to capture the differential for Toyota. You follow? That's a way to make a Toyota bet on Toyota's alpha without having the sector weight. So you can offset the positive weight in Toyota with the negative weight in the sector spider to capture the alpha. And now if the sector goes down, well, you've shorted the sector, so you make money on the sector going down, and as long as Toyota doesn't fall as much, because you know a rising tide lifts all boats, and the same thing the other direction. So that strategy would allow you to capture the alpha for Toyota. You get it? There's all sorts of ways you can use these things in active strategies or in passive strategies. Okay, good. I mean, I'm laying it out as though it's passive, but they're used very actively as well. And then the other one I passed around is, you know, a lot of you folks are international, and I'm very interested in international. But sometimes we want to know, academically, I want to know how the market's doing. And one of the problems I face is I don't know what's going on in different parts of the world because they might not be open for trading at any given moment. but I might want to know what's going on in that marketplace. Sometimes we can find indices that trade in US time that are actually for companies elsewhere, which is handy. And so the most common indices that people use are called iShares, or international shares. And they're the same thing we were talking about, but they are built on the Morgan Stanley Capital Indices, or MSCI. And they seem to change names every 2 years or 3 months. And Tyler, you can go ahead and release that. That's that one there. And so if you wanted to invest in Mexico, or you wanted to invest in Germany, or you wanted to invest in emerging markets as a broader class of a bunch of smaller countries, you could invest in an ETF that only invested in emerging market companies. And with one investment, you could get that representation in your portfolio at very low cost. Not trying to beat those markets, trying to be those markets. You follow? And then you can do all the strategies we talked about internationally. You can also ask questions like, what's going on in that market now? Because I'm awake now and my market's open now. And they'll trade in US markets, in US market time, which is handy for us in the US. Do you get it? Because I mean, something might happen in another market. Something might happen in our market, for instance, that affects that market. And if you look at what's going on in that market, but that market's closed, you might incorrectly say, boy, that market didn't react to that news. I'm going to invest in that. Or I'm going to sell that. But of course, that's erroneous, isn't it? If that market's closed, it can't react. But if you're looking at the traded instrument in the US that's following that market, that is going to react. And there's lots of ways you can make that play. The ETFs internationally are the easiest way, and I think the best way as well. There are some other ways, but that's probably the best way. All right, so a lot of stuff we've talked about. Let's leave it at that and try to finish up our risk and return notes then. I want to complete risk and return. So here's a related Dilbert. Dilbert can be a little mean at times, but kind of funny. When starting a mutual fund for investors who aren't bright enough to know their alternatives must be a huge market, otherwise most people would invest in index funds. What's an index fund? Ouch, ouch, you're making me wag too hard. Now, that's when you're supposed to laugh. Thanks, Kate. Okay. We were talking about risk and return, and we were almost done, and I want to make sure I finish that up. And I grabbed the wrong one. So we were a slide or two away. I just want to make sure I finish up. How do you use these tools? And really, I don't really want to spend a bunch of time already kind of extending beyond your notes here. I think I'm going to skip, and let me just say you're not responsible for it. So we got to here last time.
So yeah,
Yeah, I got to change. Thank you. Appreciate it, Adam. Okay, so we talked about this slide, right? We got to this slide last time. Let's pick it up there. But now we're not interested in, now we're back to our notes. This stuff matters. It's used all over the place. If you didn't get that, you weren't listening. And we only touched the surface. I mean, we go 7 different directions from the things we started with. My good friend who works in finance and has been a bond trader and an equity trader and a portfolio manager, and he says, make sure you tell them that all this stuff is used and they should be paying attention all the time. So I'm a little too passionate about finance, but you get the idea. So we've got this equation here, and this equation here from your notes is actually that far board. The required rate of return on any given asset is given by the risk-free rate plus the beta of the stock times the expected risk premium on the market in terms of terminology, and that's just the equation for the security market line. The required rate of return on any stock is given by the risk-free rate plus the beta times the slope of this line, which is the expected market risk premium. Term in brackets up there. So this line is that equation over there. Thanks, John. Go ahead. In terms of terminology, the market risk premium is just the return on the market minus the risk-free rate. We have to have an estimate for that to use it. You're still going to get different answers depending on what manager you ask. But you know, at the beginning of every year, You can ask a whole bunch of financial managers. In fact, there's a whole bunch of these things. Every time you open the newspaper on January 1, you'll have all these prognosticators saying, we think the market's going to do this year. And they'll give you your guesstimate about what they think the market's going to do. As a financial manager in a company, you need to make a decision about what you think the market's going to do over the coming year. And we usually state that in terms of how much do we expect the equity market to earn above the riskless investment. Interestingly, that's the same question I posed to you, right? Remember way back when I said, if you put your money in the local credit union or the local financial institution, how much do you expect to earn? And you all know those numbers roughly. You know those numbers are real small. Let's say that's 2%. And if I asked you how much do you expect to earn in the marketplace if you've made an equity investment, you all were willing to take a stab at a number, right? Let's say you said that number was 9% or 10%. That difference between those riskless investments and risky investments in aggregate is called the risk premium in the market. So the typical numbers there, the numbers we just use, are big. That spread between those two investments is very big. The typical numbers for forecasting and for using in management are between 3 and 8%, depending on how optimistic you are about what's going to happen in the equity markets. So if you're very optimistic, you might be more towards 8%. If you're very conservative, you might choose a number closer to 3%. And whether that's conservative or optimistic depends how you're using it, of course. If you're investing, a low number is conservative. If you're discounting, a low number is optimistic, right? Depends, you follow that, right? Low interest rates are good news for borrowers and bad news for lenders, right? Depends on your perspective. So the required rate of return on an asset is just this equation, which we saw in the previous slide, which is the equation for that line. We call the difference between the return on an investment and the riskless rate, we call that the risk premium. And for the market, it's the market risk premium, just in terms of terminology. The beta is this axis here. In terms of thinking about this, the risk-free rate is the vertical intercept. That's where the beta is equal to 0. The definition of beta is what's the covariance of an asset with the market divided by the variance of the market. Just look at the numerator. What's the covariance of a risk-free asset with the market? Well, what's the risk-free asset? It's not the risk-free asset. The covariance is 0, but the risk-free asset is a constant at the beginning of each period, right? And remember, a constant doesn't covary with anything, right? It's not a random variable. It's known. And therefore, its covariance with anything is 0. Therefore, the numerator is 0, and it doesn't matter what the variance of the market is. 0 over anything is 0, right? So the beta for the risk-free asset is 0. We can just observe the rate, and that's the vertical intercept here. As we take on more and more risk, the security market line tells us what we ought to return, and then we can ask our analysts what we think we will get for those different investments, and we can do things like we did with IBM over there. If IBM's expected, did someone look that up for me, by the way? What was IBM's beta? No one has a laptop going that looked? No problem. Yeah. Pull up Yahoo Finance. It's pretty easy to find there. So if I told you that IBM was expected to earn 15% and it had a beta of 1 and its required rate of return is 12%, you would all say, what? Let's check the dynamics of this model, because it does work well. Let's say IBM had a beta of 1. Actually, I've already got it over there with the beta of 1.1. Let's go over here. IBM has a beta of 1.1. My analysts tell me its expected return is 12%. The required rate of return is 10%. What do we say to our investors, or what do we do? We invest in it because it's a good thing to buy. That's the same as the price being too low. So return too high is like price too low. Do you follow? What's going to happen to its price as we put buying pressure on it if most folks agree with us? Its price is going to go up. What happened to the earning power of IBM by us doing that? There might be a marginal increase, but not much, right? Because it has a little more access to capital potentially, but that's all. And remember, we're separating those two things. So the earnings power stays about the same, but the price you divide that earnings over has increased. So what happens to the return? It has to fall. So if you buy something above the line with a positive alpha, what's going to happen in the marketplace as the prices get bid up, the return's going to settle back down. I just want you to see that the dynamics work, right? The market pressures are going to push it back to the line in equilibrium. How about something below the line? That's going to lead to selling pressure, which is going to force the price down, which is going to force the return up until it's again back in equilibrium. Default? Here.
Where do you see the data, you see? Like
Let's
for
look.
young,
Did someone else look as well?
it's 0.81.
Let's look for IBM's beta.
0.81.
Oh, 0.81, you got it, great. Thanks, Eric. Show Eric, will you? So that was a little typo here, it's 0.81, okay? Good? And so we can figure out what IBM's expected return is. Sorry, expected return by talking to our analyst, we compare that with the required return. We get off the line here. For instance, if we said, I have an example here. If I don't, let's do one. Okay. So for instance, the expected return on the market is 12%. The risk-free rate is 5%. So the premium is 7%, this difference, right? If the beta of this company is 1.2, then the required rate of return on this company is going to be 5%, plus that stock's risk premium, which is given by the beta of that stock times the expected market risk premium, or 13.4% in total. So this is what we require as an investor. So now I can say an equity investor should get 13.4% and they'll be happy with this investment. So in class, when I said that Reedy Sports had to earn 10% and you said, huh? I said, no, it's right here, 10%. Now you know where to go get it. It's still a judgment call though, right? You still need to have, I mean, this number we can talk about ways to calculate, this we can observe, but this you have to use your judgments on. And as I said, that's the 3 to 8% range that most folks use in here. Good? Like,
Where is the beta coming from?
So conceptually, it's the covariance of that asset with the market over the variance of the market, which doesn't help you much. Practically, it's here. You know, practically, if you want to estimate it, this is how it's estimated in industry. You take the last 5 years of monthly data, you take the S&P 500 return, you take PepsiCo's return, you put the scatter plot on there, you ask Excel what's the slope of the line that connects that in a simple regression, and out comes the beta. Again, step one. That's the answer to your question. Practically, what you would do in practice is do what I asked Eric and Harry to do, and you look it up on Yahoo. Yahoo will tell you that. That's only step one again, because there's a whole bunch of ways you can calculate this, and if you remember your management science class, there's a whole bunch of problems that happen in regression. For instance, if you're looking at a company in a scatter plot here, actually, let me leave it at that for other conversations later. There's another, you know, you can always go 6 more steps on this thing. But that's the answer to your question. Just trust me that there are a lot of problems in estimating these things, because there are lots of problems in regression that can arise. And typically what happens is high beta companies tend to have very high unsystematic risk, which makes it hard to do the estimation. In fact, I was talking to one of last year's, your classmates that's in the next year now, and they're actually trying to do this for a project they're trying to value. And the company, I kind of misunderstood the question, so I started on the wrong path. But the effective point is, if you're looking at a very high risk company, these scatter points don't line up nicely. You know, a general regression is you're looking for a nice ellipse. If you take a bunch of statistics, that's what a nice regression line looks like through the scatter plot. It's a nice elliptical pattern, okay? But unfortunately, if X is really risky, if Y is really risky, you don't see that ellipse. What you tend to find, even though the true pattern might be that, I don't have a different color. Even though the true pattern might be that, if it's really, really noisy on the Y scale, that gets really spread out. And so you end up finding something that looks much more like a circle. And if I want to estimate a line through a circle of points, I end up finding something very flat. And so that's a problem, because we care about beta financially. And if I underestimate the beta, by definition, so this is truth, and if the data points are really scattered and we don't have enough of them, it's hard to identify that line. So even though the alpha is 0 and the beta is this, the slope of this thing, I end up finding a beta that's too flat and an alpha that's way too big, right? And so you think this is a great investment. It's low risk and it's high alpha. But in fact, it's not at all. So we have lots of corrections we can do for statistical problems as well. And so instead of Yahoo Finance, if you're working for a big company, you'll probably go to Ibbotson or a couple other providers that are out there as well. I can't think of them right now. And they have a beta book. And they have all sorts of corrections for the different regression problems that might arise, where you can look up the beta for your company, and consultants will have estimated it 7 different ways, and you can say this way is most appropriate for my company. But the art of finance is in getting that beta and using it correctly. But the short answer to your question is look it up, do it mechanically, like I said, and even if you can't do it, you can be creative in some ways to do it in your next finance class. For instance, your company doesn't trade. I know you have a question there. Give me just 1 second. For instance, your company doesn't trade. You can't estimate this regression because you don't have these points, right? You don't have the PepsiCo points. You don't have market prices to look at returns to estimate the line. But you might find there's another company in exactly the same industry that has the same risks as you, so you find what we call a pure play. You find a company that behaves like your company, and you creatively borrow their alpha, their beta. And you use their beta to get your rate of return, the value of your project. So this is where the art comes in. But it's never quite as simple as you think when you first ask the question. And finance is neat because you're putting together economics, statistics, and lots of interesting things happen. And you've usually still got some, I'm going to force this round peg in this square hole a bit at the end. So I don't want you to think it works perfectly, because there's always issues. But there's two ways at least to get it, right? So the rest of these slides here, a few more notes we can look at. This slide matters. The nice thing about beta is I showed you at the outset that risk is not additive, right? That the risk of the portfolio is not the sum of the risks of the parts. That was one of the very first statements we had. And in fact, we showed you that going back to like lecture 1 as well, didn't we? If we had IBM doing this, and we had GM doing this inversely, we said that half of your wealth in IBM and half of your wealth in GM led to a portfolio that was relatively flat, right? And I showed you that a few different ways as we went through this material. It doesn't have to be perfectly negatively correlated, but there are lots of times when the risk in one asset is offset by the risks in another asset. So the risk of the whole is not the sum of the risks of the parts, right? In terms of standard deviation, which makes life messy. It also makes it interesting to find. Good news, the beta of the whole is the sum of the beta of the parts, which is very powerful. So you can't say the standard deviation of the portfolio is the weighted average of the standard deviation of the pieces. That's not true. And we showed you that a bunch of ways. But what you can say is that the beta of the portfolio is the weighted average of the component betas. That is true. You follow? So I want to create a portfolio that has a beta of 2, and I want half of my wealth in this company that has a beta of 3. I need to put half of my wealth in another company that has a beta of 1. And I'll get an average beta of 2. That's probably a bad way to do it, but the beta will work out, right? Good. So betas are additive, which is nice. I'm not going to worry about new literature. Don't worry about the last 2 slides, non-examinable. The CAPM is the beginning point. It's the launch point for other models. And we basically know that the CAPM fails. As we told you, all models fail. But the new models that we use are extensions from the CAPM. So instead of saying, basically, the required rate of return is given by the risk-free rate plus the beta times the expected risk return on the market, you add other terms where you say this plus some sensitivity to other risks. And my preference would be, if we were to extend that analysis, would be to lean us towards, on the conceptual side, something from an intertemporal CAPM or a Merton world that basically said, what causes the picture over there to move up and down and around over time, and let's hedge against those risks, just like we bought home insurance. And that's the best way to do that. That's not what the industry does most often. What the industry does most often is, do the Fama-French's model. They basically have this equation, and they say, this model's wrong because it doesn't capture this, this, and this. We tend to find that small firms do better. And we tend to find that investments in value companies do better than this model predicts. So they add another term related to size and another term related to value. But it's sloppy because we don't know where they come from. The other models that actually say, here's a risk and here's what it leads to in terms of terms are more elegant, and it's nice because they take the theory to the practice as opposed to just saying, here's how the model misses, we're going to just add a term. When you take the second approach, you're almost certainly going to miss because you didn't get the right term because it doesn't fit in the theory. So I'm less supportive of using the Fama-French approach anyway. But good. So I threw a lot at you today. I hope some of it stuck. I think that's what all I wanted to cover. So make sure we've done all the stuff I brought. Got your assignments for you. Yeah. Might actually be done 2 minutes early for a change. We'll find something else. So what we're going to start doing next is, let me give you just a kind of a lead into what we do next, and I'm going to shut some of this stuff down while we're doing that. Any questions before I shut things down? Okay. And you have Yanni's class next? So we'll leave the projector on. Someone say no?
We like the background of this one.
What's that? Okay, I'll just log off. I can't turn it back on once it logs off. Okay, so let's talk a little bit about kind of some simple things. I'll pass these back. You know, you can read the comments later. But let me ask you a simple question or two. You and I'll be very slow with this because I'm going to try to hand these back while we talk. But let's suppose you're taking a class and there's a 50% midterm. Okay? There's a 50% midterm and a 50% final. And you get 80% on the midterm and 100% on the final. What's your course grade? Come on. Go again? There you go. Thank you.
90%.
90%. Awesome. And if I told you something, if I told you that it was 30% for the midterm and 70% for the final, that'd be pretty straightforward, right? 0.3 times 80 plus 0.7 times 100. Agreed? Everyone knows how to calculate weighted averages too. Good? First step's done. Again, told you, I'm nothing slow while I'm doing this, but we're going to get all this done. That way you can digest while we're going. How about if I told you you invested in a bond, and the bond was going to earn 5%? The bond was going to earn 5%, and the equity investment was going to earn 10%, and you put half of your wealth in each. How much would you expect to earn? 7.5, good. And how about if I told you that you were going to put 30% of your wealth in the bond and 70% in the equity portfolio? You would expect to earn what? Tell me in a formula.
What rate did the equity do again?
10. So tell me in a formula. May June, sorry.
So that's 5% times 0.3 plus 10% times 0.7.
Okay.
Divided by 2.
Yeah. Oh,
Yes. So 0.3 times 5 plus 0.7 times 10. Everyone with us still? Yes?
Wouldn't
Good.
be divided by 2.
No.
they add up to
Someone else address that. Kelsey.
Well, the 0.3 and 0.7 add up to 1, so
Brendan.
that's all your funds.
Yeah, you're right.
So if you put half in each, it would be added 2 up and divided by 2, which is what you're thinking about. But that's the same as multiplying by 0.5, which is 1 divided by 2 in each case, right?
Yep.
And the half and a half add up. Sam. Where's Sam? Thank you. And good. Good, excellent. We're making progress. Seems like, boy, those are trivial questions, and they are. But hopefully you'll see where we're going. Let's think about a balance sheet. So everyone agrees in terms of a portfolio and what we did today with that last statement, that if you put 30% in bonds that earn 5% and 70%, it's actually a very simple example of our expected return calculation, right? If the bond portfolio was going to earn 5% and the stocks were going to earn in our portfolio 10%, and the weight was going to be, we rate it as 0.3 and 0.7, then we would say 1.5% plus 7% gives us 8.5% as an expected return, right? Simple? Great. Easy weasy, as my first finance prof used to say. Good. So if I were to think about a balance sheet, at market value, we're always interested in market value. So let's think about a balance sheet. We open up the financial statements and we go, okay, I take a look at the number of bonds they have outstanding. Let's just look at the bonds. And the bonds represent, say, about 30% of the balance sheet here. And the common stock, and there's no preferred, represents 70% of the balance sheet. Are you with me so far? And the bond investors have a yield to maturity that they require of 5%, and the common stock investors in my company, they do what we just did in class, and they say that they require 10%. Oh, look at this example. Right? Then how much do I have to earn on my assets to pay these folks? It's the same calculation, right? You get that? let's keep talking through this till we get there. If I earn 8.5% on my investments in my projects, let's just talk through that. If I earn 8.5% and we continually invest in the same projects, just to keep life simple, and I earn 8.5% on my projects, what does that mean in terms of the payments I can make to my various claimants?
You could just make the payments.
I can pay, by making 8.5% of my assets, we know my balance sheet balances, I can pay 5% to my bondholders and 10% to my equity holders. Everyone gets that? So 8.5% is what we'll call in the next chapter. We got a few details to sort out. I'm ignoring taxes. I'm ignoring some other things. We're going to start adding those things back. But effectively, you get the intuition already. If I earn 8.5, and I want to make sure we get the forest here, so this is nice to give us a chance to talk about it and then come back. And everything is now full circle. You understand why we need to care about bonds and stocks so much. Because by figuring out what we need to pay our bondholders and figuring out what we need to pay our stockholders, we know what we need to earn on our assets. Because we have to pay those folks for providing us the capital, right? If I earn the 8.5% and I used 30% bonds and 70% stocks, I have made enough money to pay the 5% and the 10% promise to those two claimants, right, of the company. What happens if I earn more than that? What happens if I earn more than 8.5%? So you know how to do an internal rate of return on your project's cash flows because we did that before too, right? Let's say I do the internal rate of return on my project and I earn 10%. What does that mean? What does your finance, I want to see where your finance is at. There's some more handouts floating around, or I pick them all up? Again, if you earn on a project an internal rate of return of 10%, what does that mean? We can just leave that as a question for next time to talk about, but if we have an answer now, it's even better. Yeah?
You're adding wealth to the company, so you could either
Good.
plow it back or pay it out as a dividend.
Okay, you're a step ahead of me though. I don't know what we're doing with it yet, and I'm not interested in the cash flow. So I don't care about the plow back or payout. What I care about is who gets it. Do the bondholders get any more? If you get your promised payment as a bondholder, do you get any more? No. Do the equity holders own it? You get it? Absolutely. So that IRR bigger than the weighted average cost of capital is going to create a positive NPV that we could have also calculated. And that positive NPV that we calculated is going to be with 8.5%. And the NPV that we generate is owned by who? The shareholders. So the shareholders own that wealth. It may or may not be cash flow yet, depending on when those cash flows occurred, right? But the wealth that they created, the NPV, is real, and that is theirs. And so we figure out how much we have to pay our bondholders, how much we have to pay our stockholders in proportion to the amount we use, debt, and equity, and the amount that's left over, the residual, is the net present value. And the net present value could be positive or negative, and it does match up with your IRR, and actually everything's full circle. So this takes us back all the way to chapter 1. So someone asked me a couple of weeks ago, do I have to know that stuff for the final? How many chapters are on the final? And my answer to you was, at the time, if you recall, that's on your course outline, it's very specific. But I want to warn you very carefully up front right now that it's very cumulative. I could literally say just the weighted average cost of capital chapter and the risk and the derivatives material we're going to cover at the end, and that would exhaust the whole course. Because you can't do weighted average cost of capital unless you can calculate yield to maturity, unless you can calculate the required rate of return on company stock, and unless you know the Gordon's growth model that we did in the stock chapter as well. So I mean, I can reach back to any chapter from the cost of capital chapter. So the material is very cumulative, and that chapter tells you how to bring it all together. So things will come full circle in our next couple of conversations. And then we'll start meaningfully dealing with risk. And I'm late, sorry again. I owe you about 5 minutes now? I'll send you a bill.
Just give us a little tuition.
I'm giving you, I am. That's what I'm paid to do is teach, and I give you a little extra. I'm not even going to charge you for it. Go ahead and leave the door open for me, will you?
So did you guys want me next week or sometime? You can just send me an email or you can call me. Monday, Tuesday, pretty much all day. Because you're So, well, look, I'm free.
So I'll look it over for.
Let's get out of the way.
Yeah, sorry. I'm sorry, Bob.
Yeah, you're not wearing a miniskirt, so.
He wants to hug as well. He's
That's good. That's good.
I'll give you a hug. He's friendly.
Every answer my contract, at least once every of line but the marks.
Oh, really?
I've always
Yeah, bumps screwing up is like my regular grade.
yeah, if it is true.
I think so.
What's wrong with that board? Why are you alive?
Yeah, that'll help us with the final project. I mean,
What's good with technology? Do you have any expert here? I'm trying to switch the camera at some point.
I'm back here with that.
I don't know. Well, you worked the lab.
It's not on.
That was easy. Well, it's not. Got a wide range. Yeah, so it's good though.
Yeah.
You're a freak of mine.
You had to bring donuts?
Oh, it's here from Kelsey. Oh, right. Next time there'll be 3 total boxes.
Early Monday.
So how about Friday?
This is really important.
I'm trying to not interrupt. I'm just standing here quietly.
I can feel your tension.
There's no tension. There's no tension. Because once I sit down, I'm going to be in your way. Because if you lean forward, I'm going to go like this. And if you lean back, I'm going to go like this.
Back and forth.
No squeaky chair either. Darn it. Thank you. Too brief. Too long.
Today we don't have a case, but I put some slides online, so if you're going to go check that out, I'm going to talk about the projects. We're going to get organized, so you can just import them, or download. That's a hard word. Well, everybody seems here, so welcome, everybody, welcome. Welcome to Marketing 506, Marketing Management. A pleasure to be here. Today we don't have a case. Today that's my game plan. What I want us to do this is to get well organized for the project. And this is the way that I sit at this moment. The project is by far the best value that you have left in this class. We have 3 cases coming up next week. So you can get some points out of that. But that project is 25 points. And at this moment, everybody is having a decent grade. So if you have an excellent grade on that, I mean, you can shoot very high. So in terms of value, in terms of grade, you can do great with that. But even more importantly than that, in terms of your learning, this is your chance to take a real-life problem and to solve it. So there is a lot of good learning for you. And finally, and this is something I'm always quite excited, this is you have the chance to help someone. For example, I think your dad is involved in the business you're doing, Matt. Same thing with Kate. So you have the chance to really help someone. So that is a good contribution. So let's make sure you're well organized. You do a good job at that. Also, I would like to talk about the exam. The exam, well, it was too long. I took responsibility of that. There are some key concepts that I want to make sure that we understand very well. For example, segmentation, that was not fully well understood. So I will come back on some key big concepts that if we don't understand well, that's going to haunt you for the rest of your life. Virtually, like branding. I mean, there is always branding. And that question was not super well answered. So let's answer that for a while. Just make a plan. A few announcements as usual. Let's talk about cases a little bit. Cases, I mean, this is like hockey. When you play hockey, people are good competitive. You can have some bump, people are going to hit each other, you have some discussion, sometimes it's quite heated. That's going to happen. So that happens with cases. The worst thing that can happen, the worst thing, this is when you don't have those conversations. So sometimes it's going to get heated, we're going to talk about that. So let's not worry about that. What I'm much more concerned about, this is people with whom I don't have discussion. And still, there's this group, there's a segment of this class where you do have to participate. You have to participate much more. Remember, in organization, you can be very smart, but if you don't communicate that, if you don't think that on your feet, then people will never notice you. Then you will not be promoted. That is something that the studies have shown. You need to be able to defend your points, to communicate your point, to have some debate, to have some fight, but you have to do that. And I'm still struggling with a segment of this class. I've been trying to have you talk much more, hold back some people. I mean, this is time for you for the rest. We have 1 month. Let's finish that very well. This is time for you to force yourself. And I'm going to try to give you room, but you have to play with me. And let's not worry too much about those heated debates. This is good. All right? Any questions about that? So let's come back on that last case. I really like this last case. So the last case, the key thing in that, it was a complementary product. We have the blowers, we have the blankets. So what's the big strategy? We all realize that the blower should be a penetration strategy. We need that so that people will buy the blankets. So if we don't sell the blowers, if people don't have the blowers, we don't have a business. So we all understood quickly, Caitlin started with that, we need to penetrate the market with a low price of the blowers. The big questions that makes the difference between the best of you and probably not the, well, the big question, what do we do with the blankets? So that was the big issue. We had a good debate about that, but let's come back on that. Probably the continued business, what you sell every year for the last 15 years, it's not the blowers, this is the blankets. So all your business, your profit, your success will depend on your ability to price well the blankets. Okay? You needed to be concerned about the positioning, but what was very important, because all your survival depends on the blanket, your pricing strategy, this is what we could call profit maximization. I'm sorry, there is no such thing as profit maximization in real life, but we try to do as much profit as we can. So we really try to have, this is based on this formula. We need to have a price which will give us high volume with a reasonable margin. If the price is too high, that's going to kill the volume. If the price is too low, we have high volume, but we don't have enough profit. So we need to find that sweet spot where profit will be maximized. And that they started at $12. They realized that $12 was probably too low. A lot of volume, not enough profit. People would still buy it because the competition was around at $20. So the sweet spot probably was somewhere between $15 and $20 for the blanket. All right? This is this issue that makes a difference between very successful businessman and someone who's not as successful. First, as a class, you need to realize that the big issue was the price of the blankets. If you didn't quite realize that, I mean, you want to keep working hard. Then finding this right price was very hard. All right? It was not really a scheming. If the price is too high, then it was a danger that people would say, stop screwing with me. That's my problem with my razor. At this moment, I have this razor, very nice razor, shades very well, but the blades are so expensive, I'm just about to change technologies. Because I can see that they're messing with me. So that's something you want to be careful. So finding the idea of the price was really price maximization. I don't like this word because there's no such thing as maximization. But it was about that high volume, good profit. Any questions? We have time to discuss that. Typically, we don't have that much time for the cases. Today, we have some breeders, we have some time. So any burning points we'd like to make about this case? Good? All right. I want to make some announcement about the 2 cases coming up next week. One is about Yorkton. I picked this case because it's a sexy case. I mean, it's a fun case. This is fish which are genetically modified so they can glow in night. I thought, well, that's a fun product. It's like shoes for moves. I like those sort of a different product. What happened? They had so much PR. That product is one of the most successful PR campaign ever. When people saw that genetically modified, they said, whoa, and that raised a lot of ethical issues. So they had so much PR. So they really thought, well, we have a winner here. For some reason, with all that PR, the level of sales tends to be fairly low, and they have a hard time to make profit. So what is the problem? And honestly, I've been reading this case. The teaching notes are really bad, and I don't know what's the problem. I would also think it's a very successful product, but for some reasons, it's not. So those are some big issues we have to address. The first 2 are given in the case, and I added 2 more. The first one, they're trying to find new distribution outlets. So should they go with independent pet stores, chain stores, kiosks, and the internet? I think it's not the real big decisions we have to make, but we have to make that decision. Another one, international expansion. Is it something they should consider, yes or no? So that are the 2 decisions identified in the case. I don't think this is the big issues. So I added 2 more issues. They are not in the case, but we'll spend more time to talk about that. They are very successful PR campaigns. Why these PR campaigns hasn't turned into sales and profit? So I think probably they need to back it up with something else. So should they try to back it up with some push or pull strategies? Pull being advertising and push being more like trade discounts or things like that. So I think it's more important. I think even more important, and Matt would like that. The business is all about licensing. They have a patent from someone else. They don't own the patent. So they took the patent, they have this license, and they give the license to someone else. So they have to give some royalties to the patent owners, and they take some royalties from the producers. So basically, the values that those people bring in real life, this is, maybe it's not enough. So should they get more involved in production or distribution? I think that is a big question. So let's try to address that. In terms of SWOT, I think it's mainly qualitative. This is what they say. They have some numbers. So if some of you can find some good numbers to back it up, I mean, thank you. But I didn't see much numbers. But I think it's possible. So I know that some people are quite creative in terms of numbers. So in terms of SWOT, I've identified many things. But honestly, I don't really know what's wrong. So this is when you see a big laundry list like that, that's because the guy doesn't know what he's doing. So at this moment, I'm not quite sure what's wrong with that company. So let's do our best. Yeah. Any questions about this case?
Are these just the insight slides?
Yeah, this is online. And then next Wednesday, a week from now, we have a fabulous case I really love. People who likes a good fight, you will like that very much. This is about A1, that's Texas. Fabulous brand. One of the strongest brands in its product category. They are under attack by Larry's. Larry's is the brand leaders in which product category? Have you ever heard of Larry's? Salt and marinades. Top leaders in salt and marinades. A1, top leaders in steak sauce. A1 decided to go in marinades. And oh, surprise, Larry's decided to go with the steak sauce. what do you do? So the big questions, as A1, you have a very solid brand, you do nothing. You can do nothing. It's like that little brother that want to fight with you, so little slap, and this is it, right? All you defend. But then the question is, how do you defend? Do you do something with the marinades? Because the marinade has something to do with that. Do you withdraw or counter-attack on the marinades? Do you do a similar promotion because we're very aggressive on the price? And we know that if we are the strong leading brands, the price typically don't want to touch your price that much. Do you do something with coupons? Do you do more aggressive ads? How do you defend? So the big questions, you defend yes or no, and if so, how do you defend? In the swap, this is all the usual. But something good, when you have to go into a fight, if you understand why the guy wants to fight you, that helps very much. If that's because, I don't know, you sleeping with his girlfriend, I mean, you know you can have a fight here, okay? If this is something I don't know, you're cheating and you're stealing some of his stuff, so you can stop doing that. Those examples are bad. Basically, Larry's, you have to understand the motives of Larry. If Larry's is coming in the A1, in the steak sauce, as a form of retaliation to A1 going in the marinades, then you can withdraw your marinades, they should withdraw. If you think they're coming to develop a successful business, then it's different. Then you really have to fight in the steak sauce category. So think about the motive of Larry's. And there is nothing obvious about that. Okay? Some good numbers with A1. The best way to do the numbers with A1, give me the income statement of A1. Then, depending on your decisions, show me what's going to have which items of the income statement will have an impact. So start with the income statement. All right? That is my best case. I love that case. Simple, a nice, clean fight between two heavyweight fighters. So it's just a nice fight. Okay? Any questions about that? I mean, this is something to look forward. We have a lot of good cases. A lot of good cases coming up. Please be prepared. When I hear people that they are not prepared at all, we don't have a good class discussion. I feel that I have to teach much more. This moment, make sure you skim at least and you have a sense of what's going on. Then we're going to have a much better discussion. And for people with a low participation, it's your time to shine. And we're starting to hold back less and less people who wants to do it. Because let's have fun here. I mean, I'm here to have fun. All right? Good deal? Good. At this moment, I really want to talk about the project. This is where there is a must value. You get an A on that project, probably you get an A in this class. You get a C on that project, you lose your scholarships, you kick out of the program, and your life is over. Not as dramatic, but that, if you want, at this moment, this is the price to invest in this class. This is the project. The first presentation is coming in 2 weeks. So the top review, this is what we have. We have 7 projects. Those are the projects. We have a dog food. What I'm going to ask you for all those 7 projects to give me your elevator speech. One of the best advice I received when I was in consulting was, well, you should have 3 speeches. One is a 30-second speech about what you do in the elevators. You see someone, the person asks you, what are you doing? What do you do? Then you have 30 seconds to make a very good impression. So 30-second speech, a 5-minute speech if you sit with someone and they want to hear more, and then a 45-minute speech with good slides where you explain what you do. I'm asking you a 30-second speech about the project. So you think about that. Then after that, when we have a good sense of everybody's project, I will assign you to a time slot for the presentation. The presentation will be April the 19th, the 21st, the 26th, the 28th. 2 presentations there. Well, 2 presentations for those 3 days, 1 presentation here. All the case, the teaching notes, all the writing is due for everybody April the 30th at the end. And remember, you have to give a peer evaluation about that, very important. The peer evaluation is online. to assign you to a day. I have those little cards. So after your elevator speech, I will ask you to pick one of those cards, and the date of your presentation is behind. And they're all my business cards. So. All right, so 30-second elevator speech. Who wants to start? You all have to go. Nick, I can see you want to do that. All right, just for to ask Nick to do that.
All right.
So Nick is doing
Microbrewery. Yeah, we're just talking with the owner of Blue Falls Microbrewery about what he wants to do with excess capacity, how he wants to expand in the Palouse region, Pullman and Moscow.
Yes.
And if you should bottle or do cakes, to do retail or do selling bars.
Fair enough. This is a microbrewery just beside.
Out by ICS.
Yeah.
On
So,
the
so they work with them, they have extra capacity, so what they should do to grow themselves, they need to know that. Please everybody go to that bars. I mean, they're kind enough to participate in this class, so let's give them some business. And feel comfortable to invite them if you want them.
Okay.
All right?
Yeah.
So, I'll make you pick a date. All right. I'll ask Morgan because.
19.
So Morgan, when are you presenting? 21st. Which, the second or the first one? So, April 21st, first session. Is that correct? All right. Who else wants to do the 30-minute speech? Thanks. Kate.
Okay, so we're working on my parents' company. They used to have a janitorial and floor care company, commercial. My dad got sick and they sold it, and now they're restarting it. So we kind of want to help them get a start and look at things that they could possibly change. And they're starting over from scratch, so we want to, you know, within the next 5 years, get them back up to at least where they were. And my dad knows a lot about the business already, but we want to not take exactly what he thinks he knows, because a lot of times entrepreneurs think that they know everything, and my dad is very stubborn, and sort of take a look at the things that he doesn't and contact outside places and see what the bidding process is like from an external view, so that we can come back and give them something that is worthwhile for them and that can get them on a faster track to where they want to go.
And they have a big goal, right? I mean, they have 4 million sales within 4 or 5 years.
Yeah, well, I think back up to at least 2 million a year within 5 years.
Yeah. So it's not a small business. Well, it's a small business, but not small. It's sell millions. All right. So time. That's correct. So what do you have?
26.
26. The first or the second?
First section.
26. The second. Excellent. Who else?
No, you said.
Give a nice, cool little preview. It's like a movie here.
The first section.
I go see.
The
First
one.
section. I mean the first, yeah.
Like that.
Yeah.
I mean, it's like a previews. I mean, previews explain a lot why people go watch movies. So see that as little previews. Caitlin.
So we're working on Coach, which was once a stronghold in the luxury handbag industry for women, and they've recently lost momentum because of counterfeit activity. So lots of the counterfeiters are taking over this young demographic that Coach has recently put lots of graffiti lines and bright colors out, that the younger people that Coach was once targeting are being stolen by counterfeits. So Coach has to react in order to retain their brand.
So Coach facing a problem of counterfeit. Not a small problem. Excellent. So exciting presentation. It's a brand presentation, but it's quite deep.
Do you want me to do this one?
Uh,
That one is specific.
I'll ask someone else to pick that one. It's just too complicated. All right. The 19. The first or the second? So you're starting. Excellent. I'm always easier on the first presentation. Then I'm really hard on the others. The first persons to come up, usually they have a bit of a slack, and all the others, I expect us to build on that. All right, Matt.
So we're doing perfect dry, which you
you guys don't think, but I would say chemical process and applied to during dining phase of organic fibers makes it waterproof and breathable. They derive the revenues principally from licensing, and their jobs are pretty much branding. The problem they're running into right now with the data they've got is to determine how they should be collecting the revenue. Whether it should be whether the pricing model should be through exclusivity and increased percentage of wholesale retail sales, or get rid of exclusivity and instead of collecting monopoly rents, have it be more the high volume.
So it's a licensing problem, exclusivity versus volume, basically. Excellent. And that's also another brand issue. All right?
April 21st,
21st, 2nd. That's right. All right. Flowers. Online flowers. 30-minute elevator speech.
So we're going to be doing working with an online flower company. Recently, within probably the past 3 years, the economy has tanked a little bit, and so the floral industry has gone down as a whole. So we're looking at their sales and how they could stabilize and maybe increase and go back up to what they used to be at.
Very good. This is an online website selling flowers at good volumes a few years ago. Then, because of the situation is going down, they're trying to bring that up. Very good. Simple problem, probably hard to solve. So we like that.
April 26th.
26.
2nd.
26. Sorry, not that one. Bags. 26, second. Right? All right, so dog food and what is that?
Shelf reliance.
Yeah. Shelf reliance.
Yeah,
What the hell is that? What did you pick that product? I mean, you could pick any product you want.
Shelf reliance is actually my brother-in-law's company.
Ah!
And it was a company established garage in 2005. He developed this food rotation.
Nice switch from the garage to basement.
It's a food rotation system that the first cans you put in roll forward, and then the first cans you use. They started selling door to door, and now their distribution has gone through mostly online through Costco, and through parties, kind of like Tupperware type parties that they do as well.
With their exciting?
Yeah, they've also added a new line just recently in the last year or two of food product. It's called Drive Foods, and they're trying to come up with ways. This is dehydrated or freeze-dried foods. They're trying to come up with a way to get people to buy this food and use it in their daily cooking and daily use so that they can maximize.
Because at this moment, this is just for prevention, right?
Yeah, yes. It's food storage. It has a shelf life of 25 to 30 years. And so they're trying to create a way that the people will use it in their daily cooking, and so that they can maximize customer lifetime value. They're thinking of ways that they've talked about doing like a gold, silver type of customers, and they want to take discounts for those customers to keep them and have them continue buying food.
All right. Thanks for the short 4 minutes, 30-second speech. I'll pick for you. What about that? That's one. April 19, the second. 19, the second. Which the dog food makes you the last one. It was a hard trade-off, huh? So the dog food, you're the last one. So we're gonna finish with dog food. Better be very good. Dog food. Yes.
This is a real case of my sister who lives in New York and working there for about 3 years now. And I don't know if she was, laid off or she quit from the company. And
she left her job to do that.
Yeah, and she started to build her own doggy food company. And the distinctive competency of this food is, she insists, is that the convenience. she just need to microwave for 30 seconds, and it's very ready for her dog. So she's trying to sell this product online or offline around her neighbor area. Yeah, so the big problem is.
So as you can see, good, interesting project. You seem to work with people that you love, so think about getting a good grade, but also to help them. That would be a great satisfaction to help them, great learning. And if you want to bring people in the classroom, please do so. They're very welcome. All right? So at this moment, you should know when you present. No questions about that, it's clear? So let's talk about the written part. Let's talk about some of my expectations, what you should do. So the written part, total of 15 points. So far I give you 2 points on the little report, which is probably too much. Not all well done. The case, then the teaching notes. For a total of 15 points. So let's see in details what is all that. Well, some feedback on the little report first. Remember, a good case always starts with a good issue, a good problem. A good problem is defined by good alternative. Buzz was a good problem because we have 5 good alternatives. So don't think just issues, things of good alternative to have. Math has 2 big alternatives. This seems hard to pick, right? So that makes probably a good issue. So remember, try to define the problem based on the quality of the alternatives. So far you did, I'm impressed, you did a good job to find good primary information. What you need to do at this point is to find good quality external information about the industry, about the consumption. Every time we read a case, we have very good information about the consumption, about the competitions. That could be out there. A fabulous data bank that I discovered maybe 4 or 5 years ago, and that has changed the quality of all my team projects. This is GMID. Who heard of GMID before? Because you took my class, right? That is like, it's beautiful. And you have access to these data banks for the rest of your life being a WSU grad. That will provide specific data for a given industry in virtually all the countries on the planet. The master to find this information, her name is Mary Geddes. She's the librarian specialized in business. Very kind person, very helpful. This is what she does for a living, helping people. Basically, with GMID, you could find in the US a nice long report about beer, about dog food, about flowers. You find one good report, your case would be so much improved. And this information is out there and very likely to be there. A good talk with Mary Gillis, 30, 40 minutes with her, would be worth your time. Okay? And remember GMID, when I started in international marketing, my projects were like all based on nutrition. Now when they find that, they find one good report, beer in China, wine in Indonesia. And the quality of the project is just so professional. And you will have access to that when you start to work. So that is really worth your time. Teaching notes. Writing a case is fun. I'm going to push you to write a teaching notes. Why I'm doing that? I make this commitment to you. If your case is good, if you want, you can submit it to IV case business. If you want your case to be published, we can submit it. There is no way on earth that they will never accept anything if you don't have a strong teaching notes. This is why sometimes I look smart, because I have the teaching notes. You don't want to teach a case if you don't have strong teaching notes, because you don't know how to cut the case. The teaching note is cutting the case for you. So you have to do that. It looks like a big, short case analysis, and I will talk about that in details today. So you have a model with Harrington, and also you have still 2 teams to come see me. You don't have to do it if you don't want to, but I think typically those meetings are helpful. All right? Something I didn't say, I wish I would, but I think I didn't ask for it. You need a good outline of your case, just to organize the work. For example, with the beer, you have a good outline so you know who's going to do what. And typically for all cases, this is always the same big logic. You probably noticed that. We're starting to be good with cases. We start with the macro environment, micro environment, the alternative, then the decision. So basically, try to follow something like that. You don't have to. But all this information should be there. So typically the introductions, you start almost right away with the issues you're facing. And then you give a little background about the context. Okay? Then you start with the macro environment, the big trends and consumptions. Then the micro environment, all the competitions. Then you go with the firms, the strengths, the weaknesses, the DC. Then you go with the specific decision of the key alternative. Then at the end, you always finish with the issues. You start with the issues, you finish with the issues. Always looks like that. I don't care about the length. I mean, some very good case, A1 is a short case. Augustin was a short case. Chevrolet is a super long case. The quality of the case doesn't depend on the length of it. But I have to give you some form of a guideline. So I would say between 12 and 18 double space page, including everything. Typically, we have good charts, good tables, you have appendix, you have reference, things like that. All right? Any questions about that? Teaching notes. That is really key to publish it. I mean, this is why I'm forcing you to do that. And that's going to force you to make a decision about that. Because a case is just a description. This is where we'll see how smart you are. So around 5-10 double space page, this is short. Typically it's longer than that. Typically, the teaching notes are longer than the case. But well, I don't want to push too hard. So start with the summary of the issue of the case. Always talk about the targets as undergrad versus graduate student. Something when you teach a case, this is all about how you organize your room. So you can tell the faculty member how they will organize their boards. If you can always spend a lot of time thinking about that. Because that allows me, when you make a comments, I know where to go. Yeah. The big questions you ask to the class, and those big questions, that becomes really your SWOT. So you tell which big question should you ask, and then what should be the answers to that. And that is really your SWOT. Yeah. The key analysis to perform, what kind of break-even, estimation of the size of the market, CLV, things like that. Remember, you need numbers. Then the pro and cons of the alternative. Then your best solution at the end, all the sequel. I don't expect you to have a sequel. I expect you to have your best solution. And this is what your family members, your friends are going to like the most. So do a good job at that. Then your key learning points. But basically focus on that. It's like a big short case analysis. Do you have a good sense of what it is? Is that clear? I know that Howie had some questions about that. Is it clear?
No, it's good. Yeah, the model teaching looks good.
All right. My expectation when I'm going to grade all that, typically the way that I grade is I put all the presentation, everything that I have, and I make stat. So like that's my A plus, that's my A, that's my A. So that's the way that I grade. I don't should have criteria, but I give you criteria. So basically, I'm more about the content than the format, but the format is important so we can see the content. That's something I had to struggle at the beginning. My written English was not fabulous. So I had good ideas, I think, but it took me like 2 or 3 years before being credible with my writing, just because my writing was not very good. So I had to hire copy editors. So make sure that your format, the writing side is good. Basically, the content starts with the good, strong issues, good logical structure, the high quality content, which means good primary and secondary data. I want to see qualitative and quantitative data, high quality teaching aids, well-justified final decisions. So all that is probably 75%. Format, where it's a professional exercise, if we have to submit it, it has to be very clean in terms of writing. So high quality writing, good storytelling, appendix references, things like that. My English, my written English cannot be fabulous because I learned it too late. But I'm a good storyteller. This is why I'm always first authors on my papers. That makes a difference. Tell a good story. It's like movies. I'm a big movie fan. And we're seeing movies, they don't put everything that they have. They make sure they have a good stories that flow. So make a good story. This is my comments for the written part. Any questions? So let's talk about the presentations, which is out of 10 points. Basically, this is what I have in mind. I'm open to suggestion. You're going to have around 35 minutes. You're going to be responsible to teach half a session. Okay? Before your presentation, send us 5 or 6 slides about your case. I don't expect you to have your case written. That would be unfair for the first ones to present. But send us something so we can have a sense of what's going on. So a few good slides. And I will post those slides 1 session before. So if you present on Monday, I will post the slides on Friday before. Present on Wednesday, I will post the slides on Monday. Okay? So give us something. Structure of the presentation, and that is open to discussions. This is what I had in mind. The first 10 minutes, because we didn't see the case, tell us your story. Tell us your big issues, the big information we should have. Then, because this class is based on cases and discussion, let's have a discussion. 10, 15 minutes, it's not long for discussion. So you cannot have 8 discussion points. You can have 1 or 2. For example, last case, we could have 30 minutes discussion on the pricing strategy on the blankets. So pick 1 or 2 good discussion points with 2 big alternatives, which are quite different. Good example was the blanket penetration or versus price maximizations or skimming. 3 difficult options. Then we can discuss that forever. But you have 10 minutes, 10 to 15. Then at the end, this is your time to shine, to show us the key learning points, the key assessment you needed, and your best solution. This is why you paid for by the entrepreneur. You're not paid, but this is where I will see the very good team. This is what I suggest. If you had any thought, would like to do that different, I'm open. Basically, I want us to understand what you do, to discuss that a little bit, and then I want to give you a chance to show me your best solution. You can reorganize the time if you want.
I think the description and context might be a little bit more for some people. I mean, I know our product takes a little bit of explanation as to how it actually works and the problem is a little bit complex.
I would be flexible. I would not stop you after 10 minutes now. Now we need a discussion. No, I will stop you after 35 minutes. Okay, at the end, the peer evaluation group is very important. If there is one place I finish people, you can have a name of the project. If you're a free rider, I give you a so I give you a C. So if everybody agrees that you did nothing, I mean that moves. Okay, so the expectation again, but typically, as I told you, I grade that by much more relative. Like that's my best presentation. Then that's probably my weakest. Then I decide that that's a strong A. That's like a B plus. Then I put people in B. But you want criteria? I'll give you criteria. So an interesting presentation with a good description, high quality discussions, moderations, good and fun interactions, sound assessment, insightful learning points. Form is always important. When you present, you have good presenters, you have poor presenters. Being a good presenter will help you quite a bit in life, to get promotions, in consulting to get contract. So try to have a good form. So time management, you need to have a good control. I expect everybody to participate, and I know that for some of you, standing up, do public speaking is not your forte, but I'm expecting everybody to say something. Just as part of the learning point. But it means that those people who don't feel very comfortable, they can do the first part, which is very, very controlled and descriptive, and the strongest speakers should probably come at the end. You can strategize. Fun presentation, original with marketing, damn it, let's make it fun. Enthusiasm, I like to feel that there is a team, not just one or two dominating. Professionalism, where I'm from, which is aestheticism tends to be relatively important. When you present, typically you dress up. I will not force anything on you, but it's a bit my expectation. I mean, if you come in jeans and t-shirt, that might bias my perception of the rest. So this is what I have to say about the presentation, about the projects. At this moment, this is the last time we talk about that. I hope it's going to be the best point of this class. We see that and we feel super excited. We learn a lot. It's really, really fun. I hope it's going to be like that, and I think it's going to be like that. Do you have any questions? Is it clear everything you have to do? So, at this moment, I would like to talk about the exam. There are 2 points. The first 2 questions, I think at some point we'll come back on that. So I'll give you your exam. I'll take it back after. Maybe someone can have it.
What did I get?
And remember, you have a 0.7 additions to that.
7 points.
I think so.
Read it off
All right, everybody stand, and I'll tell your names and faster. Mitch, Eric.
Here.
Very helpful, thank you.
Yeah.
Alex, Sanjay, Brendan,
Formulate our questions.
Brendan,
I don't know how far we are.
Gracie, Nick,
Yeah, we need to
I don't like my
figure that out.
Caitlin, Jennifer,
Just get it done. Check it out.
Matt,
Lewis,
Christine,
That's good for me.
Brett, Mike, Arsenal,
my height is 4.6.
Kate, Brett, Pragya, Sam, Ted, Kelsey. Let's see Kelsey.
She went to the bathroom.
Is Kelsey here?
Yeah, Kelsey's there.
David, Lindsay. Thank you. David. You can have a look at it. I don't want to come back. I want to come back on the first 2 questions, not because I want to bug you. That's because I think they're good learning points that we need to have well understood, well covered. That's something we'll face all the time. So what I'm going to give you 5 minutes to skim it. 5 minutes to discuss with someone about the first 2 problems, what would be the best answers for the first 2 problems. Then let's have a discussions about that.
Crazy classic history. This examples like
What she told me is that she made a mistake. That was a grade, but she made a mistake on the rule.
Well, I'm in class.
I hit average. I always do average. Pretty much everything. I don't know. I think I lost an entire point on this one. Are these the correct answers, Nick? Okay.
So I'm going to focus on question 1, questions 2, because questions 3 basically, what was question 3? Question 3 was the same damn exercise during class divided by 2.7. Okay? It was the same thing during class. You can see your notes about that. And the case overall was pretty well done. So I want to come back on the concept. So questions 1, questions 2, make your little focus groups about that. And let's discuss that in a few minutes.
Okay. Hey, Nick. Nick, compare your answer on this one to my answer.
Okay, well, hold on. This, let's look at the points per word.
I know. Did you do pretty much? I did pretty bad. What would you like to discuss?
I got it.
What?
Sloppy handwriting.
Sloppy handwriting? I lost a point for sloppy handwriting. Didn't we say the same thing though? Parents?
Come on, no, don't use that to come back at me. I didn't grade it.
You didn't grade it? Well, you need to take a look at this then. I lost an entire point for sloppy handwriting.
Well, for any personal issues, I will deal offline. Okay, so if you have something very specific, if you disagree with your grade, for some reason, we'll not do that as a group. What we do as a group is to understand the big ideas behind question 1 and questions 2. All right?
What?
So any personal issue will be resolved on a personal basis.
Many probably consume burgers. Probably.
Don't make me regret to do that.
What?
This needs to be addressed.
What?
What do they say? They may prefer ethnic food over burgers, although many probably consume burgers. This needs to be addressed. The problem of ethnic people not eating burgers needs to be addressed. Not prefer food or may prefer.
Well, but you get what I'm saying though, right? You get what I'm saying?
Yeah.
Okay.
I also like lukewarm water with my tea. So.
All right, you don't seem to talk about that too much. So let's talk about. I want to come back.
I mean, that's the full point of
Questions
that.
1. Who needs more time? Who wants more time?
I did.
Nobody?
Read the top paragraph.
All right, so let's do that all together. I mean, Nick and Mike, any personal issues, I will resolve that offline. At this moment, I want to make sure the big concepts are well understood. I want to talk about that for the key learning points that I believe are needed for the rest of the case and the rest of your life. First example, the broccoli burger. I didn't make that up. The idea of the broccoli burger is one of my high-key teammates. He's a faculty member in biology, and he had this great thought of broccoli burgers. 3 years ago, that's something he pre-tested with focus groups with MBA students. People love the broccoli burgers. And they have all those ideas of what should be the segmentation, target, and the market size. We spent a year to talk about that. So this is pretty much a stop. Okay, so everybody read question 1? Do you have question 1 in your mind? Basically, my first questions, I want to make sure that you have a good sense of what is segmentation. So a good sense of the process of segmentation. I give you your points for the big ideas, the big steps. So what are those big steps of segmentation, which I believe truly matters? I didn't grade the exam, but this is what I told many. They should realize that when you do a good segmentation, you have two good solid steps to that. You have the first one, this is the segmentation. And the second one, this is the description. Your answer had to be built around that. The segmentation stage, this is what I'm trying to emphasize in this class. We always have that propensity to break things down based on social demographic. This is virtually all the time a mistake. You break that down based on the why, the benefits, or the values. In this case, it was clearly parents looking for good health products. The way to segment was based on health conscious, health concern. It was not based on social demographic, not based on different cultures. This is what I was looking for. But then when you have that, so you could have segments like people, parents concerned about health, parents price sensitive, things like that. When it's broken down based on values and benefits, then you can describe based on other things. Age, number of kids, locations, things like that. But it was this big logic I was looking for. Clean 2 steps. The first one based on values, benefits, things like that. The second one based on social demographic. Let's move on questions to the target. We're pretty hard on you if in that target you use kids, because we know that kids will not be buying. And if you use some social demographic, because it completely goes against this idea. Basically, we give you points for something about health conscious parents with no time, looking to feed something good for their kid, but also health conscious, things like that. But if it was kids or multicultural segment, the multicultural segment was bullshit in that case. I mean, it makes no sense to segment things based on that. Yes? This is what we're looking for. Again, we graded based on the big ideas that we always discuss in this class and we always keep discussing. Are you with me? I hope I do make this ha-ha. Because I'm a bit disturbed when I see people using kids and social demographic for their targets. I was a bit disturbed when I saw that. It made that impression, like you just feel like going for beer and stop talking, you know. Okay? Do you understand the word? I always grade based on big logic. It was the big logic we have. To estimate the size of the market. When Tobin told me that the size of the market should be 40 million burgers per year, when you read something like that, that should raise a super big question mark. There is a big problem. Basically, we're looking for key big steps to have a good conservative size of the market. You should have realized that the size of the market is very small. Basically, we're looking for an illustration of those 4 steps. Because we talk about that quite a bit. Focusing on the buyers. Focusing on the parents. That was the first one. Then, mini market. The guy is based from Portland. He will not sell in Florida. So what kind of geographical location that he can go after? So the quantity of burgers that the parents will buy per year. And once you have this number, based on those 3 steps, this is the full market potential. We know we will not get that. As Caitlin said, there's going to be a percentage of that typically will vary between less than 1%. And the top numbers that you can get in terms of market share, the top brands typically would have what in terms of market share? Roughly. Things of Red Bull, things of A1, 40, 45. And you need to be a hell of a brand to get that much. So typically, I was hoping that we will make some assumptions about who is winning plus able to buy, and then I have a proportion of maybe between 0% and 10%. But basically, I was looking for those 4 steps because we have seen those 4 steps. They are good 4 steps. And then you illustrate or implement each step. So that was what we had in mind. And always keep that for the rest of your mind, because not just for the exam, it's just something you learn by heart. It's just a very good way to assess the size of a market. Focus on the buyers, not the number of kids. Then make some conservative assumptions about the geographical locations, how much parents will buy per year, and then you take that number to make a small proportion of it. If you're a new product that nobody has never heard of, you will go with that 1-2% that Caitlin has said last class. All right? Does it seem like a big surprise to you when I say that? It's like, oh, okay, what? I really thought it was straightforward. Good. Mike, you said no.
No, I know, I agree. Trying to figure out how I lost points on it.
Yeah, me too. That's what I'm
After
trying to
doing
figure out is
exactly
I
that.
wrote all of
Well, the way what I tell, I didn't grade it. But I give the instructions for grading. What I told Mania, because the average would have been low, I said, let's grade around the big ideas. Basically, take your best, give him an A. Take your worst, give him partial credit. As long as he wrote something, give him like, don't go lower than 60%, let's say. Then put people in between. I mean, our standards, we have 2 forms of standards. We have the perfect answers that I wrote in details, and then the comparison with others. Okay. So maybe for you it's clear that this is those 4 steps, but maybe compares to others, and compares for someone who keep reading. If this is not super clean, then you didn't see it. If you have issues,
Let me see what you wrote.
at this moment, it's not about your grade. If you have issues with your grade, keep that in notes. Come see me, we'll discuss that. It's important for me to understand your grade. At this moment, I'm discussing with my class about the big ideas that I want you to have for the rest of your life. You don't understand, come see me, we'll address that. All right, fair enough? Brand now. I was a bit surprised. We always talk about brand. We have at least 4 or 5 cases about brand. A1 is about brand. Vernon was about brand. Which other? Help me, which other? Anyway, we care about brands. Basically, I was looking for 2 big dimensions of brands. And then, a brand is based on 2 things. This is based on identification. All that, this is the visual aspects of a brand, the tagline of Red Bull, the little bull with the wings. So this is all the physical attributes of a brand that when you see that, you recognize it. You have Coke, you see it's Coke because of the logo, because of the colors, things like that. But then, you have the meaning phase, which is based on the perception, which is based on the promise, which is based on the emotional associations that you make with the brand. Always those 2 dimensions. One of the #1 problem with branding, and I'm not sure that we get it in this class. We always focus on the identification. Venom, right? We have that big eyes. I mean, we have that snake-looking, edgy look. I mean, they spend a lot of time to think about that. But then when you think about the meaning and the promise of it, you don't have a clear promise behind that. Red Bull has a clear promise behind that. The premium give you wings, whatever, image behind that. The problem is that we always forget that part. And then I think I had a very nice slide that I put together about that. And I think that's really the essence of what is a brand. A1, as strong as a brand as you will ever see. Love this case for that. But A1, we recognize that, the little bottles, we recognize the taste. But what makes A1 fabulous? This is the promise behind A1. A1 is the only real steak sauce. This is what people believe. They believe it very strongly. Because of that, they have a 50% market share. And virtually nobody can attack them virtually because of the promise. And probably half of you have no clear mention of that promise. Yeah. Any questions about that? Eric, I could see question marks in your eyes.
No, I'm good.
All right, and the last part of it was based on that little video that we saw with Ross Warner. Because I think, I asked you this question because I think it's a fabulous insight. You don't mess with your brand. You don't mess with your brand when things are hard. The two big attributes when things are hard, you don't stop your advertising. Because if you stop your advertising, you stop supporting your brand. And your brand, this is your key assets that you want to protect. That's the first one. The second one, if you start to mess with the price of a strong brand, then people will believe that that price is the real price. When you try to bring that up, people will react negatively to that. You almost never touch a strong brand with the price. You just do that if you're really in trouble. This is what we're looking for. So attack on the brand and the negative price perception on the brand. And I thought those insights was very big and things like that. They're all key insights, just very good lessons for the rest of your life. At this moment, I have a hard time to sell my house. What's my reflex? What's my reflex at this moment?
Drop the price.
Drop the price. Is it a good idea?
No.
You know, if someone doesn't make offers on my house, maybe not because of the price, because the market is very small, and maybe I should just invest into some cleaning or invest in my grass to increase the value. The way that people buy a house, they come in a house, the woman will love it. If she loves it, she will buy it. And it's not 10 grand at this level that's going to make a difference. So it's hard, even for me, and I understand that at TJAC, and I've reduced my price. So remember that for A1. Yes, David.
Well, I was just gonna say, the house that I live in, the guy who owns it is the dad of one of the kids who lives there, and he just, I mean, we live up on like Terraview where there's a lot of like families and professors.
Yeah, I live on Terraview.
You live in Terraview?
You could.
I'm in Terraview, my house in Terraview.
The way he rents it, he makes more than he pays back.
Yeah, well, renting is an option. So I've got a case with my house. Like, reduce the price, invest in something else, increase the value, be patient, renting. Renting is a bit of a problem. Because if I rent, I cannot buy a house where I'm going. I'm not here. If there is a water damage, I cannot kick anybody's ass, right? I know where the phone is really, really hard. If they have 2 dogs, what can I do? I cannot come and kill a dog. Things like that are in my mind. So renting maybe was my last option.
Okay.
This is the big aspects I wanted to come back on. I mean, this idea of segmentation, target, size of the market, branding. If you're in marketing, if you're in business, all your life you're going to deal with that. So they're all good insights that I hope are becoming like second nature to you. This is why I came back on that. Well, this is all I have to say today. If you have any questions, burning comments, if you have problems with your grade, come see me. It's important for me to have a good sense of your grade. And otherwise, remember we have 3 cases left. Then there's a little lecture about my specialty. Then those good projects are coming up, and that should be the climax of this class. Well, thank you, and I'll take back the exam. I need back the exam.
How about this?
I'm gonna chat with him about it.
You know that who's that jazz professor that's really renowned in WSU? Oh, who lives in Morocco? Yeah, who a lot. He's my real neighbor. He's like my house is here. His house is here.
Real neighbor. The one?
Jazz professor.
The dog is it? Black dog? Oh, the other.
What the hell do you want? Yeah, what do you want? You want to go over here and rub your eyes for my face?
Black dog or the other?
This is my house, right? This is the house here. She's a contractor. Yeah, this is not bad. He lives here. Yeah, this one. This guy. Yeah. And the wife always walk around.
With the dog?
No. The last time when I lost my key, she came to my house every Thursday. I lost my first dog's key. You have a
Get it done, man.
Have you written my exams?
I'm gonna shoot him an email at work and see if he's available, just to make sure. I was figuring around 7. 7? No, that's beautiful right there.
No, we're going to change the MIS.
What?
This Friday.
Management office. So, you get practice in the morning and you'll be ready by the afternoon.
We actually going for 22nd.
Next week.
I don't. Will she let you?
Well, it's not about.
Yeah, she's going to let me.
Okay.
Hey, look, 3 people are going to be together.
What did you want to change it?
This is not. It's also street. Oh, one day.
No.
Huh?
No, I haven't checked yet either.
Olsen Street.
When did you guys plan?
What? This morning, as we were sitting in marketing. about an hour ago, exactly. What? Yeah, I sent you an email in class. I know. No, we agreed that we. Yeah.
Oh, I've done before.
What are you doing?
I may be. Yeah, I might be in Spokane tomorrow evening.
Are you going up for your alignment?
No, it's a long story. It's over a beer story. Yeah.
Well, I got something to your alignment. What are you doing?
I got to get. Yeah, it's a long story.
Right, so 7 o'clock tonight, we'll work on marketing.
Perfect.
You already sent the email.
I said no. I haven't sent Jeff an email. No.
Okay, so let's do. Send him an email about tomorrow.
Okay. Perfect.
So marketing's gonna be tomorrow, 7 o'clock, God's house. We're gonna set an appointment with blah 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 for tomorrow. So MIS tonight, we're cranking it out. MIS tonight, we're cranking it out. Everybody. Well, I think God and I just sit down. I just looked at what needs to be done on it. We only need to track the process, and leave the KPIs for the
I don't watch it.
Yeah, we're just gonna bullshit it out.
Wait, don't we need to get her feedback first before we bullshit it? Because what if she says, you guys are idiots, it's all wrong?
No, seriously, I'm trying to get it. He's trying to sell the house, right? He's trying to sell all this house.
When do we meet with her about our KPIs?
We don't. She's supposed to post comments on Angel about it. She has 70,000 pages to read, Nick. I don't know if she'll ever get it done. Remember?
You know what? The red is also.
The 27th.
No, seriously.
Currently, we're on which means the day before.
This is MLI. So it's all.
Saying, do we move to the 27th? Due to the fact that three of us are not going to be the chair. So, this would be 27th.
Yeah, you just go. But no, but he's going to do the online thing.
What's that? What'd you get? Really? Is that for PS3? Is that right? Nice. What do you think? You what? Oh, you haven't got to play it yet? Nice. I haven't. I used to be really into gaming, like constant computer games and whatnot, but so I don't have a single game on this computer. I have a PlayStation 2 that isn't even plugged into the gaming. It just sits there. So I really should get back into it. My brother just bought a PS3. I went over and played a little Resident Evil, whatever they're up to, 37 or whatever. That was fun.
What do you
Break knuckles on trucks. I have fun working on them. I really do. I've got a couple of friends that are doing complete rebuilds on trucks right now. Body off the frame, build the frame up, put the body back on the frame, the body full blown, month long, spend a month in the engine department, spend 4 weeks in the interior, that type of stuff. So I've been helping a lot with that. But I haven't done much recently. I've been way too busy with the program. Spring break and January, I did work on bullshit for this. Semester to be done.
I spent like all spring break studying. I did the economics thing, and then I spent all spring break studying for the accounting thing every day. And I got C.
You what?
I got C. In that class, for me.
Yeah, I mean, take it.
I wrote this down.
That's it seems so big up, then after it's sloping down. The one just not by the surrounding area, like it's so fast. It's so fast. Like the one is like still house in front. That house is really sold. There's another cul-de-sac that's really sold. Because it's really good.
Yeah, but remember, here is not.
In 5 times, what you got to say?
You guys are financing on economics. Saturday guys, should be. Sales. Monday night, it should probably be Friday, which I guess is hospitality. Yeah, I'm talking about here, nationwide.
I like it.
I have no idea. I think he's going over those formulas that he used to kick our ass in the distribution game.
I'll be at 113, gentlemen. I think we should.
Oh, sure. Yeah.
Hey, what do you got? How you guys like to drive that? How you like to drive that?
We're not going back to returning our students tomorrow because we didn't want to pay for family dinner, so we turned it tomorrow. There's food for about $8 it's like $20.
When I lived at
I look so well. Soup? Sick. So you just hold it. At least how I got.
when you went to the rec,
Normally, well, can usually do that on the
because like I know like in summer I'll try to drink the whole summer. I'll be, I get.
that's fine. You can either write one big turkey or me the other, whatever. Okay. Yeah, whatever.
And the logic, the
Why? Resource. What? What resource?
You change the buffer? How would you say?
No. The resource.
What's that?
My brother's for sure super bad.
Oh, really? Is he gonna get a new one, or is he gonna pre-owned?
He's decided to sit on mine. He's going. He had a car. He had an Acura. It's going to max.
So did you create a story about that?
Oh, this sucks. Well, this sucks. Like, there's some lots of points. Sorry, team. Okay. What is this? Yeah. Oh, you just have to make assumptions. Yeah.
You're sorry?
I expected better. I really did. 3 points out of 50. No. It's good. You want this back? No. Add it to my small collection. Which just make me upset.
I don't know anymore. Walking. Bob? Oh, yeah.
Asahi? Is it from the? Is it the same company with the beer?
Candy. There's a peach candy. You want it?
Is there any pineapple in it?
No, peach.
Peach? I'm allergic to pineapple. Like, deathly allergic to pineapple. Yeah.
That's only peach.
Do you have a beer taste?
The many allergic.
Horses and dogs and cats and dust mites and yeah. A little bit to peanuts supposedly, but I still eat peanuts. So.
I don't like peaches. I have a thing anyway.
Thanks, sir. It's pretty good. Better. I'm mad. I went through and underlined, and the guy lost an entire point on I think question 2, and exactly what he put up on the board was exactly what I had. And comparing Nick and I, he got 0.7 points higher than I did, and we literally said I obviously write a lot more, but we literally said the exact same thing, and he got 0.7 higher than I did on that question. So. Yeah, I was like, what the hell? And then on one of the questions, it's it said list four somethings about this case or something like that. So I wrote out 1, 2, 3, 4 and gave them. And then whoever graded it put others with a question mark and took points away. And I was like, so. Well, I mean, if you wanted others, I would have given you others, but you said 4, and he even underlined the word 4, so it's come on.
Four people transferred out.
I heard the point guard was going. 3 others did?
Yeah.
Awesome.
4 minutes left.
Good afternoon.
Okay, welcome to class. We have our homework to turn in.
Cold. Very cold.
We do have an assignment the next couple weeks in a row here. We'll finish up our problem set, so here's your next one.
You want to make our day, you know?
Somewhere out of chapter 5, which is topic 5, and somewhere out of chapter 6, which is topic 6. And we'll get started on that today. Any comments or thoughts on the distribution game? Any of the successful people want to share their strategy? You can see how some of it, I mean, if you're doing this for a living, you could get some feel without using formulas and probably get pretty good at guessing things.
What did you say?
It's nice, as I kind of tried to explain at the end last time, we can change the parameters a lot. You can have quite large demands. The distribution types are only negative binomial and uniform. But nevertheless, you can change the cost, the prices, lead times, other things. So it can be quite flexible for you. Actually, going to the game, it has to be 200 days. So another way to use it, not just to practice or train your workers, would be to actually try different policies. We'll give you, as we get into topic 6 and 7, some examples of good policies that have shown to do well, but that doesn't necessarily mean that that's for you. In particular, if you've got some extra constraints, like the truck only comes on Fridays or something like that, you can test it for one thing in this game. So anyway, that's yours to keep them. Whatever you want with them, brother. The other two games we're going to play are quite different. And that's still coming up at the end of the semester. Okay, any questions on anything? All right, let's finish up topic 5 here. Pretty short set of notes, but arguably the most important thing we do this semester. Because one of the most important things an operations manager needs to be able to do is figure out exactly what his or her capacity is and then do something about it. So it was a week ago, remember, we ended on this slide, and these were some ways to improve capacity that we looked at. One was cross-training, and remember, it's only going to help you if your assembly line is unbalanced. If it's balanced, actually, you're not going to get any benefit from cross-training, and you may lose some of the benefits of specialization when you do that. You might have more setup time, you'll lose out on your learning curve, et cetera. Then we said, don't forget that if you've got a bottleneck like B here, maybe if it can be split into 2 pieces with a unit at each station, you essentially would eliminate that bottleneck and make something else as a constraining factor. It's important to remember that when you do that, the flow time does not change. It still takes the same amount of time to make 1 unit through there, but it would certainly increase your capacity there, your ability to pump out units per hour. So different concepts. And then we talked about shifting bottlenecks, just mentioning that there are other operations in your system, and they may have a capacity very close to your bottleneck. So before you go spend $2 million to buy another machine, make sure that you're really going to get, it's not just the capacity at that station that matters. The increase in capacity of the whole system. All right, so that's what overview of where we left off. The next slide is just from reading the goal, some of the things that I noticed. So these are all from the goal. Balanced flow with demand. What Joan is talking about there is don't make faster than your customers are demanding it. All that does create inventory, and I think the book is pretty explicit about why that can be very problematic. An hour lost at a bottleneck is an hour lost for the entire system, and really the whole book is talking about bottlenecks and managing them, and if you manage them well, you will all problems will disappear, right? But the point is, if your bottleneck goes down or your worker's on break or whatever's happening, you cannot make that time up. You cannot work faster on other processes. So you can work faster, but it's not going to help you because every unit has to go through that. So it's very important to keep that thing running as much as possible. And for non-bottlenecks, we don't saving time there or increasing capacity there basically isn't helping you. That's why we call it a mirage. So one advantage of that is maybe you can have extra setups on these stations, which lets you have lower lot sizes, which has benefits of less inventory. And it's not, so it's tough. I mean, you take accounting class, and we all learn about managerial accounting, and they tell you every activity in the company, how much it supposedly costs. But remember that those calculations are long-term kind of deals. What they're talking about here is, look, if I've got a worker at that station, and I'm paying that worker 8 hours a day to be at that station, whether she is busy or not, if the machine's idle some of the time, it does not hurt at all to add some more setup. So I'm not paying her anymore, I'm not costing any more money on that machine, etc. So yes, accountants talk about average costing and all this kind of stuff, which has its use. But in terms of decision making and marginal analysis, you need to look at what our decision making a real change or not. So that's what we're talking about here. There are, I mean, when I was interviewing this guy for my dissertation, he was just so upset because he was selling paper or something, and in the office. But anyway, he was selling paper, and the accountant said, "This is our average cost," and he had a price above that. Well, a customer wanted to get a price a little bit below that, and he knew that the marginal cost of that was down here. This average cost included like the president's salary and all that kind of stuff. And he says, we will make money. We will earn more money if I make this sale and price below average cost, but above marginal cost, and the company would not let him. And he was so frustrated about it. It's not like they were going to go hire another president, by making that sale. It's the danger in using average costing for marginal decision making. So anyway, the book's talking a lot about that. Also use incentives to get the organization to reach your goal. So if you need to improve throughput to make more money, then figure out incentives that help you improve throughput. Increase capacity of the plant is to increase the capacity, lowering the bottleneck. You don't have to hire 20% more workers necessarily. You just have to hire more workers than the bottleneck. Very important. Inspect before the bottleneck operation. What you don't want to do is send a bad unit to the bottleneck. It's going to have to be redone, either thrown away or redone and sent back through the bottleneck. So you just wasted the bottleneck's time. And thus, lost that time for the whole system. So the idea is to inspect right before to make sure everything going into the bottleneck is a good unit. Don't waste the time, as we said, put your best people there. Don't put your newbies or your trainees on the bottleneck. Put your best people and maybe pay them the most. I mean, make that the prestigious job that they take it most seriously. Release materials at the same rate as the bottleneck. That's the idea of not running on triple negative. Where the non-bottleneck station, don't run it as fast as possible. The idea is to only run it at the rate of the system, which is the rate of the bottleneck. Because we see what happens when you run things as fast as you can, you create a lot of inventory and mess, and it really bogs things down. This is hard, it's very difficult, easy to say, not so easy to do. in a factory to have somebody sitting there reading the newspaper because she happens to be at a non-bottleneck station. That looks odd, and the president doesn't want to see that. The accountants certainly don't want to see that. But it does you absolutely no good. In fact, it does harm. So don't be afraid to let people sit idle. Now, one way around that, of course, is to get a very balanced process with balanced lines, but that certainly depends on what you're making. If it's an assembly line, it's easier. In the job shop world, it's just not going to be balanced. There's no way. And finally, practice global, not local optimization. So think about your effect on other people, other systems, other operations, every time you try to improve something. And to the extent you're using math or computers to help you make decisions, try to make it more global, looking at all the impacts. Okay. Finally, we have our little levers appendix, and it's now reached the second page. So here we have a bunch of new levers for managing these low rates. First thing is to try to manage supply and demand to increase your throughput. For example, have reliable suppliers. Right? If you are starved to work because your suppliers haven't delivered on time, that lowers your effective capacity, right? So, consider paying more for reliable suppliers. And better forecasting things, so you're not making to a demand that's different from the real one, and simply increases in demand help as well. Suppose your operation's running real well and you are processing at the rate of demand. Well, at that point, the only way to improve your throughput is to improve demand, and that would be with advertising or pricing, coupons, visiting important clients, etc. For within the factory, try to decrease resource idleness to increase process capacity. So we don't want people or machines sitting idle. Again, I don't want to sound like I'm contradicting myself. A non-bottleneck machine can sit idle, but we're talking about either a pretty balanced line or just something where you'd like to work but you can't due to starvation or blockage. Okay. So what we want to do then, for example, synchronize our flows to reduce starvation. So if we can have a more balanced line, that will help do that. So the idea is the output of every station is the same, and so each station can be feeding each other when they've got the same rate. And then in terms of inventory, we don't necessarily like inventory. It costs us money. We'll go over in detail here today. Nevertheless, if we need to improve throughput, you just look at Little's Law. One way to do it is to raise inventory. So specifically, you can put buffers in front of the station and after the station, and that eliminates the blockage and starvation issue. On your goal assignment, you should have seen that. When you put in some inventory, all the dependent events went away, and there wasn't a problem anymore. It's the same idea here. And interestingly, I didn't have you do that on the assignment. It didn't take a lot of inventory to get rid of the problem. I think I had you put 100 units in or something, but actually if you put in like 5 or 2, that can be enough to really mitigate the problem. It's not like you need a ton, but just enough kind of safety net to keep things from being starved and so on. All right, next page. Increase net availability of resources. So these are our people, machines, rooms, etc. We want them to be more available to work for us. So obviously we don't want things breaking down. So try to have a better preventive maintenance plan maybe. If you do preventive maintenance, if you can do it after hours, That means, of course, that the machines won't be down there today. I just heard on the radio this morning that they're going to shut the theaters down in Moscow, the East Side Marketplace, for at least 2 weeks to re-renovate, right? Put in new carpet and paint and all that. And wow, you know, that's a lot of lost revenue, I would think, for them. Especially since those other theaters closed over there, I would guess that's been pretty popular. And their argument is, well, we can't even think about this and make decisions with people in the theaters. And my thought is, yeah, you could also go there at midnight and do your work between midnight and 8 and close one theater at a time, you know. And so it's interesting. I'm not sure that's the best policy, but that's the same idea here. If you can do your repair work, your maintenance work after hours, obviously that helps the resources be available during hours. Reduce absenteeism. Absenteeism is a big capacity killer. One way to do that is to increase morale and have happy, motivated workers through, sometimes pay does that, an exercise facility, daycare, you know, all those human resources, things we think about, can really make a difference to your bottom line. A lot of these human resources efforts more than pay off in terms of, you know, employee loyalty and lack of absenteeism. Reduce setup times, or I'll add, or schedule better. The idea there is that if you're setting up a machine, it cannot be making something. So you've lost that capacity of that machine. So if you can figure out ways to reduce those, you can get more out during the day. So don't just think of a setup time as given just because you've been doing it for 20 years. Have some thought, get your workers involved, get the engineers going, and consider spending money to make that setup time lower. That's exactly what just-in-time production is all about. The Japanese figured out ways to make setup times low, and that made it optimal to have small lot sizes and set up a lot. If setup times are high, JIT doesn't work. Change the product, and schedule better could mean just get items that have similar setups together so it's easier to go from one to the other. There's a whole literature on scheduling. Those of you that get into this. And then 4, change the product mix. And in particular, we're talking about in this context to reduce setups. So consider you've got a product that has a high setup cost or time, and you're not selling very many of them. It may be worth your while to drop that line or to drop those customers. D, increase your theoretical capacity. So these are basically the same things as we talked about for going faster in terms of flow time. Same idea here. What can we do at the bottleneck? We can work smarter, faster, get the quality up there so you make it right the first time and you don't have visits, extra visits, and change the product mix. All of those things would potentially get your bottleneck capacity up. Also, we talked about splitting it into multiple parts. You can subcontract or outsource. In other words, we are moving the work content elsewhere. So this could be the whole bottleneck. It could be part of the bottleneck. It could be part of the demand. In other words, some of the units simply don't go there. We have somebody else do it for us. Those are all options for getting more out yourself. And the basic idea of well, a few reasons to subcontract. But one is simply to improve your throughput. You can't make it all quick enough, so you have somebody else do it for you. And even though the cost might be higher, you get more sales. You're willing to take that lower margin. And D, invest in flexible resources. These can be machines that can do multiple things or have very low setups. It can also be workers that can do more than one thing. And we saw a simple example of how that might help. Another reason to cross-train is when you do have absenteeism, it's easier to substitute people. Other ways to increase theoretical capacity: increase batch sizes of the bottleneck resource can handle. So our analysis was mostly talking about 1 unit at a time, but if you make things in batches, and your bottleneck, for example, is the oven, if you got a bigger oven that could cook in the same amount of time, you can now process more units in the same period of time. That increases your capacity. 3, add resources in the bottleneck, so add people, machines, whatever it is. And finally, simply work longer, if you're not already working 24 hours a day. All those things that you pump out more per day. All right, any questions on topic 5? Well, it's time now to enter the wonderful world of inventory theory. I know you've been waiting all semester for this. We could certainly have a whole class in inventory theory. I don't mean class session, I mean a whole course. What I'm giving you in the next 2 topics, I'm pretty convinced is more than 95% of the MBA programs in the world, in terms of formulas and stuff. We're going to go over things that aren't in your book, aren't in most books, etc., to give you as much of a toolbox as I can in the short time we have to spend on this. So I've typed out a lot of things to save us some time, which I guess is good, but that also means if I'm going too fast, if you have questions, stop me. We're going to go through a whole bunch pretty quickly. Get this started on Wednesday. So, topic 6 is about inventory when we know what demand will be. And topic 7 extends up to the case where we don't know what demand will be, or that we have random demand. Now we modify our policies accordingly. If your demand was known in your distribution game, you would probably done much better, right? I have said instead of the uniform distribution, demand is 2 units every day at every store. You could have in fact figured out exactly what to do to completely minimize your costs and have perfect fill rates and things. Right? So as soon as we introduced that randomness, that added some difficulty. And what happened? Either you didn't satisfy all the demand, or you ordered too much and you paid too much holding costs for that safety net. So that's a difficult issue to handle, and that's what we'll be doing in topic 7. I typed out a little notation page for you again. To get it on one page, the font size is smaller, so hopefully you can still read that. So we're adding a bunch of things. I won't go through this right this second, but everything in bold is new for topic 6. And really, that's there. I mean, you're not supposed to study it, say, for a test. It's just there. If you come across a symbol and you don't remember what it is, instead of flipping through 50 pages of notes, you can go to that page. All right, so what is this thing called inventory? This is the I in Little's Law. Inventory serves as a buffer between supply and demand processes that do not fit neatly together to mitigate the costly disruptions that would otherwise occur. There aren't very many perfect supply processes in the world. One that may happen someday is the replicator on Star Trek, right? You're hungry, you go to it and say, give me Earl Grey tea, and it makes it for you, and you have your Earl Grey tea instantly, right? And yet, you don't have to store that in your cabin, okay? Who knows, we may or may not have that something. We sort of do if you think about snack machines and microwave ovens. doesn't get a bad rap, but actually, it does have that instantaneous nutrition satisfaction element. But anyway, what's happening now, there aren't a lot of perfect processes, but supply of water to your house is a nice example. In the good old days, somebody had to go to the well or walk 5 miles in the rain, and they're carrying the buckets. And that still happens actually in parts of the world. And you have to store your water in pots or in bathtubs or whatever for all your water needs, the drinking and the bathing and cooking, etc. And this has been, since the Romans, I don't know who started plumbing, but this is one of humankind's greatest inventions, really, is getting water straight into the home. And so if you think about it, you don't store water at all. You turn on your faucet when you need it, it's there. When you don't need it, you turn it off. And in almost all cases, if you turn on the faucet, you'll get water. So there's no risk. Hot water is a little different. We actually store that in a water tank, and if you do use too much, it'll run out for a period of time. For cold water, what we like to see in our businesses. So inventory actually has different kinds. They're all important in different circumstances. Theoretical inventory is what we really mean when it shows up in Little's Law. And this is the amount of inventory we've got to have in our system to get the throughput we want. Because if flow time T is any length at all, more than a second, and you have no inventory, you can't have any throughput. Right? So you've got to have some. And in general, if you think about the automobile factory that pumps out a car per minute, you've got to have a partial car in every single station, all the way back up the line in order to do that. Okay, so we call that theoretical inventory. And in general, that's not considered something we necessarily try to reduce, per se. And even when the Japanese or others talk about zero inventory, it's not necessarily much lower than that, if any lower at all. Cycle inventory is what we mean by the EOQ stuff, and this is what we'll be spending most of our time in Chapter 6. And the idea is if your demand is relatively recurring over time, you order, have a bunch, and then demand takes it down, and you order again and again and again. And if you draw that out, that looks kind of cyclical. And so we call that cycle inventory. We don't order one at a time in the cases where it costs us to place an order. It doesn't cost anything to place an order, sure, you can place one at a time. But it does, and so we order more than one, and that's why we have this up and down situation. You also might see it for quantity discounts, because you can only get it if you order 1,000 units, so you're going to only order 1,000 units at a time. Okay. We also have seasonal inventory, and this is intentionally having inventory knowing a high demand season is coming up. So the most common example, of course, is build up for Christmas. Walmart, if you go to the warehouse, they will, in September, they will already have Christmas things in the warehouse. It's quite strange to be there at that time. But they're exactly doing it for this reason. They can't deliver it all in December. So they've got to start building up. I don't know, but I assume the grocery stores stock up on beer for football weekend. I know they do for Mom's weekend. Apparently the Mom's weekend is more higher beer sales than Dad's weekend. And anecdotally, what I hear is if you go out on the streets on Saturday night, Mom's weekend, it is the moms that are more drunk and making more trouble than
That's true.
I don't know what to say about that.
Awesome.
Okay, safety stock. This is topic 7, and what we usually think about safety stock is this: if you've got unknown demand fluctuations. Seasonal demand is a fluctuation, but we anticipate it. right? But random fluctuations mean, you know, you're at a McDonald's and a bus of 30 kids come through on their road trip. You have no idea that was coming, right? That's a random demand fluctuation. You can also use it for uncertain supply, and this is something that's not usually done in an introductory book or course, but it's very important as well. If your suppliers do not deliver on time every time, you might want to think about having extra storage, otherwise you're starved. You can't do anything. Speculative inventory is for price fluctuations. If you know the price is going up, you buy a bunch now. And companies and people do that all the time. When I was in St. Louis, moving out here, I knew the gas prices were higher in Washington State. So what I could have done is bought a bunch of gas and put it in my car, driven out. I think there were safety concerns, probably good reason not to do that. But right, that would have been speculative inventory. And actually, in companies, you often get a letter from your supplier saying our prices are going up next month, by the way. And what that does is encourages customers to order much. Buffer stock then is, this can either be between stations or between stages. So it can be even from one company to another. But we're talking about holding product in between things so that they're not dependent on each other anymore. So this decouples the operations and allows each station to produce whatever it's supposed to be producing. And it's never starved and it's never idle. So buffer stock. Let's write down reduces starvation of water. All right, well, when we go through that list, it sounds like inventory is pretty cool and a great thing, and we should have a bunch of it. Well, as with everything else we do, there are downsides to having inventory, and they can be significant. One is the more you have, the more costs you deal with. The two most important are the cost of ordering it to begin with, and then the cost of holding it. Explain that in more detail. It's also difficult to control. How much should you have? You have to keep records of all this. You have to store it. You have to maintain it. And most of our examples will be looking at one product at a time. But what if your company has 100,000? You know, this becomes a big effort. People's whole jobs are about dealing with inventory. You have whole warehouses meant simply to deal with inventory, so it's a very expensive thing. Also, the customer doesn't care, right? They're paying for the product and what it does. They could care less how long it's sat in a warehouse or how many times people moved it from place to place. And so every time we handle that, it's adding to our costs, not adding to the value, and so presumably we cannot raise the price as our handling costs go up. So your margins go like this as you do more and more with inventory. Also, it reduces cash availability, and this is especially important for small firms. Big firms, at least in normal economic times, can get credit relatively easily, so it's not a big deal. But for small companies, you've got one employee and you've got to meet your bills every month, like a clothing store. Think about how much they spend to fill all the racks with clothing. Well, that's money they have to pay the supplier that clothes in the store. That's money that's not in their bank, and they have bills to pay. And so there could actually be a cash flow problem if you have too much. You'll get it. I mean, accountants tell us all we did is traded one asset for another, cash for inventory. And yes, once we sell it, our books say we get our money back. But in the meantime, there's a cash flow problem. Also, there's a liquidation problem, or obsolescence problem. If you have too much, You may be stuck. You may have to try to get rid of it because it's out of date or it's about to expire. So you think about bananas growing black in the grocery store. Computers that, if they're not, less than 3 months old, they may be obsolete already. Automobiles, everybody wants this year's model. So if you haven't sold off last year's model, what happens? So what do we see? At the end of these selling seasons, we often see great sales on cars and things before the new models come out. Well, that costs you money, right? You didn't get the full price for these that you hoped to get. So the more inventory you have, the more danger there is that you get it. Another problem is, if you do have new products that you want to get out, you feel like you have to get the old ones out of the way first. Because if you put the new ones on the shelf or in the car lot at the same time, everybody will buy the new ones. It's just like milk at the grocery store. If you pay attention and look at the dates, you ought to buy the one with the latest date, so it doesn't spoil on you. So the grocery store is making a dangerous, decision if they put something that with a date a week later than something else. Consumers are savvy; they'll never get the older one, and thus the store will not sell it because it's bad. And finally, okay, so these are both flow time issues. Right, our flow time for new products may go up if we have too much inventory in the way, and that's exactly what Little's law would suggest. You have to wait for the things in line to get moved. Also, importantly, and some would argue most importantly, it hides production problems. This is a famous little picture that I like to show many times. I think the Japanese are credited with this, and they take kind of a altruistic or philosophical approach to inventory. They're like, yeah, whatever about the cost, but it's bigger than that. Inventory is like a Band-Aid that hides the cancer beneath it. Another way to say it is, the ocean here is level of inventory, and down below are all the problems that we have. Unreliable vendors, scrap, capacity imbalances, whatever's wrong with our system. If we have enough inventory there, on a day-to-day basis, that's okay. We just sail over the problems, right? If you have 3 months of inventory sitting in your plant and your vendor doesn't deliver this week, so what, right? You get over it. The problem, though, is you get kind of used to that, and not only does it cost money, but you get used to it, and you don't even search for these causes, and it hides these causes. If you reduce the inventory level intentionally, then this actually exposes the rocks. It exposes the problems in your process, and the Japanese would suggest that's a good thing, that's not a bad thing. Just like any 12-step program, you can't recover until you recognize that there's a problem and admit to it. Same idea in factories. You've got to identify the problem before you can do anything about it. So if you don't have much inventory, this exposes the problems. Now you spend your effort getting rid of these. So you chop down the rocks. Now you don't have any rocks, and guess what? You don't need any inventory. So now you're the most competitive company in the world, and by the way, you're not paying for any inventory either. Right? So the long-term approach really is to not have inventory, thinking of that as a good thing. And then the wound example is the same idea. If you put a Band-Aid on your cut and never look under it, it may be getting infected, and you don't even realize it. 3 weeks later, you take off the Band-Aid and it's green or something. If you don't have the Band-Aid, at least you see what's happening underneath. Okay, so that's the idea. Inventory should not be used as a crutch, at least a long-term crutch. Okay, so lots of good reasons for inventory, lots of bad reasons for inventory, and our goal as a manager, of course, is to try to find the best balance. We want some, but we don't want too much. So in terms of managing inventories, our inventory systems are a set of policies and controls that tell us how much to have. We monitor our inventory levels. In other words, how do you do that? Do you physically count, set the store down and count all day? Do you use barcodes, computers to help you? Right, you have to figure all that out. And then determine when to replenish. And what we'll be spending most of our time on is the fourth one, how much should you order when you decided it's time to order. So in topic 6 here, we're going to do all this. Okay? And really most inventory models differ because of the assumptions that we make about the situation. And in many cases, this has everything to do with demand. What is demand like? And then how should we handle it? So first we'll look at the one product situation with demand that's pretty regular over time. So the basic model for that is the EOQ, and then we'll do 4 extensions of the EOQ. One is if it takes time to make the product, then our order size should be different. Secondly, what if your holding cost is based on maximum inventory instead of average inventory? The order size should be different. Third, what if you allow back orders? That changes things. And then we'll look at actually 3 different quantity discount models. Then we're going to look at what's called lumpy demand. So what if your demand comes in lumps, like 1,000 at a time or millions at a time? Should you order the EOQ? The answer is no. You do something else. Then we'll look at the multiple product situation because all these formulas don't consider any impact on other products. So what happens, for example, if you order the EOQ for everything and it gets delivered and, oh, by the way, it doesn't fit in the warehouse. Right? So if you have a warehouse space constraint, that could limit how much you should order. Or maybe there's a budget constraint on how much you can order this month. A lot of purchasing professionals have a budget constraint, so that again might change things. Then we'll look at joint replenishment. What if you're ordering, say, more than one product from the same supplier? But we usually give you some sort of discount for ordering them at the same time. If you think about a catalog, for example, $5 shipping and handling costs per order. When you see that, that tends to get you to encourage you to order more or more different things, because if I order my 2 different products 2 different weeks, I pay that shipping and handling twice. Okay, so anyway, when we combine those, that's called a joint replenishment problem. So we'll look at that. And finally, this is out of supply chain management, and it basically says, forget about all this. This is what I should do if I'm acting in isolation. But if I think about the supply chain and trying to optimize my order sizes through the supply chain, I really ought to be coordinating. And as long as we can share the wealth with each other, everybody will be better off. Okay, so that's another example of global optimization instead of local optimization. So what we'll do here is modify some of this to look at 2 firms at once. Okay, so that's a preview of what will be relatively fast. Any questions about anything? Okay, so let's start with the EOQ. This is called the Economic Order Quantity Model. It's been around since about 1905. By far the most used model in the real world, despite its simplicity and its many assumptions. So our problem is, how much should we order every time we place an order? And first we'll look at all the assumptions. When you're modeling, you need to write down or think about all the assumptions that you're considering. And we sort of did some of that as we did our linear programming earlier in the semester. So in the EOQ world, we assume first that the time horizon is infinite which means we will keep getting our demand year after year after year until the sun blows up. Second, demand rate is constant over time. So if it's 10,000 units a year, it's 10,000 this year and next year and next year and next year until the sun blows up. Okay? An important one is the third one. Demand rate is uniform, which means it occurs continuously and smoothly. Technically, that means every split second somebody comes in and orders a little piece of a product. More practically, it means every day we sell a number of units, and most order sizes are like one. Okay. From us, from our customers. So we have no seasonality here, or what we call lumpiness. Our big orders are like a million units from our customers. So demand goes down at a very steady rate. 10,000 a year, divide that by 365, and we assume it's that much every day. Divided by our working hours, and we decide it's that much every hour. Doesn't change. Okay. Purchasing lead time is 0, so as soon as we order, it will arrive, and it will arrive in one lot. So that means infinite production rate. Infinite production rate is usually a good assumption if you're ordering from a supplier, because usually if you say I want 500 units, they can ship you 500 units at once. Maybe they have a longer lead time, but you get it all at once. On the other hand, if you're making it, it may take time to make it. So we talked about making 1 car a minute, but suppose you're ordering such that you want 2 cars a minute in this batch of cars. Okay? And in the meantime, your customers are coming and demanding some of your product. So what happens is it takes time to make it, so over time your inventory goes up. But not straight up, it takes time. And customers are buying your product, so it doesn't go up at the full rate as if they weren't buying your product. And then we'll look at that model as well. But for infinite production rate, we just get it immediately. Or we can make it very fast. 5, no constraints on the order size. So we could theoretically order 2 years worth of demand. And there are some reasons to do that. If you're going to the moon, you probably, want to leave a fair length of time worth of supplies up there. Or, even the space station. There are other reasons to do it as well. 6, decisions for one item are made independently of decisions for other items. As I mentioned earlier, that's not always true, but for the EOQ model, we will assume it is. 7, deterministic world. No uncertainty in demand, no uncertainty in lead time, no uncertainty in supply, no defects. So we need perfect knowledge about the future, and we're just trying to demand or make decisions around it. 8, no back orders are allowed, so we have to satisfy customer demand as it comes in. 9, the order quantity can be a fraction. That's okay. And often you just round it. That's good news. That means we can use calculus to figure this out. Remember, in linear programming, you should not round if your variables have to be integer. That's dangerous. But in the EOQ, it's fine. It's round. There's actually a little formula that tells you whether you should round up or down. It's not exactly a 0.5, but unless you're building an airplane, so don't worry about it. 10, purchase price does not depend on lot size. That means no quantity discounts. Obviously, there are often quantity discounts, and we'll spend a fair amount of time on that, I think, Wednesday. And 11, cost factors remain constant over time, so no inflation. Now, if you look back at our list, 11 assumptions here, that sounds crazy, right? And demand's not going to last forever. It's not going to be the same, we will have inflation, blah, blah, blah. Nevertheless, this model was actually quite robust. So the EOQ is what we call robust, which means it gives a pretty good answer most of the time, even if some of those assumptions are violated. Now, thousands of papers have been written about inventory theory, and basically they take something like this and start playing with the assumptions. What happens if my production rate is finite? What happens if I have back orders? And somebody else says, okay, what if my production rate's finite and I have back orders? That's a new model, that's a new picture. You know, so people like me keep making twists on these assumptions to try to get a new model written. That's what research is. You keep building on what others have done in the past. And so there are tons and tons of models out there for all kinds of situations. And I'll give you a patterning of them here at topic 6. Here's what the inventory graph looks like. So time is on the x-axis, inventory is on the y-axis. The amount we order is Q. Okay? And so when you order Q, because we said that production rate's infinite, you'll get it as soon as you order it. And then over time, customers come in and demand it until you hit 0. Lead time is 0, we get it all at once, so I don't need to order early. I just order as soon as it hits 0 and I get the Q again. And that continues over time. Because demand is uniform, it's going down in a nice triangle instead of a stair step or something else. And because there's never any change, these triangles look the same forever and ever. Since there's no end point, we don't have to worry about having 0 at the end. Remember, in the distribution game, that was an issue. You should have had 0 inventory at the end of that game. Over here, if we make fewer orders, that means less often. We're going to have to order more each time, right? And it'll last longer. We order more and it'll last longer, but we have fewer pipes. And that's the basic trade-off that we're making is how much should we buy? You see, when you buy more, you have more gray there, so you have more inventory, but you didn't order as often. So you saved on those setup costs. What is average inventory in this graph? Just looking at it, either graph. What do you hold on average over time? Okay, and what is that? That's right. And what does that equal? In terms of
half of the
half of Q. Good. So average inventory is Q over Q. Because of all those assumptions, we order Q, we get it all now, it goes away uniformly, so on average we'll have half of that over time. Good. Before we look at the model, let's look at the costs a little more specifically. For now, we're not going to consider the cost of actually buying the item. It is a real cost, obviously, but we're going to buy it anyway because we're planning to sell it. And so as long as we don't have quantity discounts, it's not part of, it doesn't need to be part of our model. It will be part of our model when we get the quantity discount. But for the basic EOQ, we don't need to worry about it. What we do need to worry about are setup costs and holding costs. So the setup cost is the cost every time you place an order, and it could be these kinds of things. The time to prepare, maybe you receive and inspect every time you get a delivery from a truck, and that takes a certain amount of time, it costs a certain amount of money. Postage, order forms, telephone calls. Sometimes you have to get authorization, and that takes time or costs money. And a lot of suppliers have a fixed charge per order. Might be a tooling cost for them to do their own setup to make your special product. Might be some sort of delivery fee, etc. So $10,000 per order. If you're charged that, you're probably like encourages you to order more and more, right? Because you don't want to keep doing that very often. Okay, so those are all types of setup costs. Setup costs are also known as ordering costs. And I use those two terms interchangeably. So ordering costs, setup costs mean the cost every time we place an order. you know, when your shipping and handling costs in your catalog are kind of broken out per every $10, those are really more variable. But when it's $7, no matter how much you order, and I want a CD, I'm not going to buy just one CD because the shipping premium is like half the cost of the CD. So I end up buying a bunch more than I ever meant to, and then hopefully I don't order for a long time. But that's certainly, and you've all probably experienced that. Anytime you have a shipping and handling or some sort of fix, it tends to get you to order more. If you drive to Costco, you know, it's an effort. Once you're there, you kind of want to load up the truck. And the other issue is the products are big anyway, so you get a whole bunch of inventory when you go to Costco. But you don't go to Costco from Pullman every day, right? So when you make such a trip, you tend to buy a bunch of things. Same idea. Okay, inventory holding costs. These are also called carrying costs. Costs of carrying inventory, and they're not cheap. One, of course, is the space itself. This could be warehouse space. Sometimes you rent space, and even if you don't, even if you own the building, one way to think of this is, yeah, but if I only needed half the space to store things, what could I have done with that? Maybe I could rent it out to somebody else, or maybe I could use that for productive capability, or even sell it. So, there is often a specific space store cost, and even if there isn't, using kind of an average cost doesn't make sense in this case. Probably the most important is this one, which is the interest on your tied up money. So this is your opportunity cost of capital. And I'm sure you've been dealing with this all semester in your finance class. So we know what it is. How it relates to inventory is the following. Say I don't know, I have a little store that sells Disney figurine stuff that's expensive. And so I buy this thing for $100, this little Mickey Mouse glass thing, and I'm going to sell it for $150, I think. Okay. So I give the supplier $100, I put the Mickey Mouse thing in my store. A year later, it's still sitting there. Okay. Well, the accounting books, actually they don't depreciate the things you sell, right? So the accounting books will still say $100, and hopefully I'll still sell it. But in the meantime, I had paid $100 to my supplier that could have been in the bank or in my company earning other money for me. You know, at the very least, I could have had it in my bank and earned 1%, 3%, 5%, whatever it is. So that interest is foregone interest. By having that in inventory, I did not get the interest I would have gotten. The figure we usually use is your weighted average cost of capital, because in the big picture, that's what firms are earning on their money. And so the idea is if you have more money in your system, you have invested it or otherwise gone out and made that return. So often we see 20, 30% for this. If that seems you're not so sure, at the very minimum, this should be whatever you get on your bonds or your bank account. So that can be a very high number. Also, inventory goes bad, it breaks, it spoils, it deteriorates, and all that's bad, all that costs money. You've got to have you either sell it for less or you throw it away or whatever, right? So if a certain percentage of your items go bad, and the more you have, the more likely that is, you should account for that. Okay? Taxes sometimes come into play. This is, I know, true for alcohol. At least last time I checked, if you're making alcohol legally, at some point the government comes in and taxes you on it after some point in the fermentation process. Insurance, if you have a big warehouse, you certainly should insure all the stuff that's in there. If you think about automobiles, you've got a big lot on your car dealership and it hails, well, that's a problem because that just damages your whole inventory. So you have insurance on inventory for fires or anything like that. Now, you don't have, they don't pay the same thing you and I do, but they pay something. And so the more inventory they have, the more their insurance costs will go up. Pilferage means stealing, and this can be stealing from your own employees or it could be stealing from your customers. Stores have to deal with what, 1 to 5% shoplifting regularly. And it's amazing how many companies steal as well. Walmart, as I visited them, had a couple cases, one in particular where there was kind of a sting of workers that were taking quite a lot of stuff from them, and they finally caught them all and prosecuted accordingly. But you can imagine if you're working in a big warehouse and a little camcorder comes by, you know, the unscrupulous people find it pretty easy to grab one, put it in their coat, and try to walk out the door. So anyway, to the extent that's a problem for you, the more inventory you have, the higher those costs will be, right? And then, believe it or not, and I didn't, but I read it, so I guess it must be true. The highest workers' compensation costs are actually back injuries due to moving inventory. I would have thought of people falling off ladders or something, but no, I mean, the big picture is people moving things around. So the more movement of things you have, the more likely it is you're going to have those kinds of costs as well. Okay? So unfortunately, the accountants don't do a great job of telling us what this number should be. If you look at an accounting book, they may also give you the EOQ formula and say, go compute this. I want them to tell me how to compute this. But anyway, once somebody does that for us, we know a holding cost per unit, a hold it for a year, and we know the setup cost per order, then we can figure out how much to order. Okay, so here's how those cost curves look if you plot them. The holding cost we're going to assume is relatively linear. So if we double the amount of inventory, we're going to double our holding cost. So we have a holding cost per unit that doesn't change. The setup cost curve looks something like this. The less you order, the more often you order, and so you're going to order a lot more per year, and so your annual setup cost will be really high. If you order a whole bunch, you're not ordering very often, and so that setup cost will be low. So as you can see, those are going in different directions. As we raise our Q, if you put them together, they have this nice U-shaped shape. They're shaped something like a U, and we call that a convex function. And it turns out there's a minimum to that, and it just so happens it's exactly at the point where those two curves cross. So on Monday, when I said in the distribution game, your holding costs ought to equal your setup costs, that's exactly what I was referring to. Because if it was much higher, the holding was much higher than setup, then your total would have been somewhere up here and vice versa. This little picture is sort of obvious. See what price, oh, I need to update my postage stamp price. But anyway, maybe in some other country it's 37 cents a cent stamp. So just in the simple case of a stamp, if we order one, we need 1,000 units, we order one each time, that means we need 1,000 orders, so that's $370 if our postage. If we order it all at once, that's one 37-cent stamp. The postage alone, in this extreme example, would be saved by having more orders. Okay, let's do the first EOQ model. First assumption we'll make is that we can compute a holding cost per unit. So like $5 per unit for a year. Here's a notation we'll use. Now most books use D for demand. Makes sense? Your book uses R. And the reason it uses R is because it's all based on Little's law. is that if we believe Jonah from the goal that our throughput should equal our demand, then R is a good representation of demand. Okay, so that's where that comes from. S is the setup cost per order. H is the holding cost per unit per year. It's important to get the time the same. So your R needs to be the same time as your H, annual demand or per year. You can do them both per month if you want. Usually it's per year. Q is the number of units per order. So this is our decision variable, and when we put a little asterisk or star next to it, that will mean the best one. So we can order anything we want. Q star is the best, the cost minimizer. Okay. So you already told me what average inventory is, right? If we order Q, average inventory is Q over 2. Can anybody tell me what the number of orders per year might be? Great. So for example, if demand is 12,000 a year, and we order 1,000 every time, we will order 12 times over the year, or about once a month. Okay, so the number of orders per year is R over Q. Average inventory is Q over 2. Now we can write our cost function. Total cost is the number of orders per year times S, which is the setup cost per order. And the holding cost is how much we have on average. We said it was Q over 2. And we multiply that by the cost of holding a unit for a whole year in inventory, which is 8. So that is the total cost function of the EOQ. That is, if you put it in Excel and plot it, you'll get a U-shaped function as you increase Q. And our goal is to figure out which Q is best. I don't know if you use calculus since I met with you over the summer, but we ought to at least use it once here. This is a convex function, and we said it could be a fraction, so that allows us to use calculus. So let's take the derivative of this thing with respect to Q and see what happens. Well, remember, Q in the denominator is negative. It's like Q to the negative 1. So it's RSQ to the negative 1. We're taking the derivative of that, which is negative RSQ to the negative 2. And the other one is H over 2 times Q to the first. So the derivative of that is H over 2 times Q to the 0. Remember, anything to the 0 is 1. So that will disappear. And why do we take derivatives? Well, you might recall the point of taking a derivative is it tells you where the slope of the curve is 0. That's exactly what happens if you know this is a curve like this. As soon as the slope is 0, we get the middle point. So that's why we're doing it. Set it equal to 0. Then you just solve this for Q. Negative RS over Q squared plus H over 2 equals 0. And a couple more steps and you'll be left with Q squared is 2RS over H. Or the magic formula. Q star is the square root of 2SR over H. That is the EOQ. Well, I guess Little's law is more important, but the second formula I hope you remember 5 years from now. This one. Turns out if you take this and put it up here in your original cost function for Q and do some algebra, we can actually say exactly what the total cost at that point is. And it's the square root of 2RSH. So notice, I know the total cost without knowing Q. So I know I've ordered the EOQ. And so I know also my holding setup cost cannot be any lower than that unless I literally reduce S or H. Obviously, if your demand setup costs or holding costs go up, your total costs go up. Here what's happening, if your demand goes up, you're going to order more. Makes sense. If your setup cost goes up, you're gonna order more. Makes sense, because you don't want to order as often. And if your holding cost goes up, that's in the denominator, so you're gonna order less, because you don't want to hold as much inventory. Real quick, I don't know, we have to write this down. Technically, we want to take the second derivative and make sure it's a convex function. So second derivative is 2rs over q cubed, s greater than 0, which is what we want. If the second derivative greater than 0, you have a convex function, so you know it's got one point where the slope is 0, and that's a minimum. And we're trying to minimize our costs. Okay, any questions about that? Okie dokie. Well, starting Monday, we'll give you a bunch more formulas and rapid fashion. Have a great weekend.
Also, then you kind of go to I need to go back home. What about yeah. So yeah, I think they work tomorrow. What's your schedule?